the S&P Cash Daily. Can everyone see that? Let's just get rid of the scan that I did, and then we'll bring Gary in shortly. Can everyone see that? Gary, I don't know if you saw that, but Lance, who's got a very good sense of humour, by the way, says, "Ha ha, doctor, I need a little remedy. Every time I trade, it goes the other way." I think, Lance, you'll learn something today. So there's certainly a lot that you'll learn from Dr. Gary Dayton. Okay, so we'll bring the Master in to kick us off today. And I know, Master, you've got high regard for Gary, haven't you, for Dr. Gary? I'm sure he'll say a few words about Gary as we start. So let's get underway. 3, 2, 1, and record. Good morning, everybody, and welcome to day 4. It's Thursday. I can't believe the time is flying, and it really is flying. And it's the 25th of October, 2012, and you're with Tom Williams, the Master, who's sitting next to me. Very happy. He's been well fed the last few days. We've given him some haggis, a nice bit of roast beef, and some nice vegetables, roast potatoes. Yeah, he's a very happy man, and of course, very, very attentive to the markets and seeing some setups right now. And we're going to talk today about the Wyckoff method, and I'm delighted to welcome and really pleased to welcome Dr. Gary Dayton. And Gary is an expert in the Wyckoff method, and we talked yesterday a bit about breaking the ice and jumping the creek. And I think today, I hope that, by bringing Dr. Gary in, will start to allow you to stop using just red and green indicators in your trading, but to look at the bigger picture and understand what each bar means in context with the background. Now, I do know that some of you, will have gone to the market to try to trade, and you won't have made winning trades immediately. I understand that, but that's the way trading is. You have to understand, at the moment, the market has actually been quite difficult, some of the markets, to trade. I've found the Australian dollar to be very simple to read, and in fact, Dr. Gary, I'm sure, will tell you that his big trade in Australia was trading the Aussie dollar that he'd never really traded before, but was able to do very well on. But before we start, we're going to get Tom to take a look here at the S&P, and we're going to look at the ES. Let's go to the pound F contract, which is the continuous futures contract, which is what Tom has got up. Okay, and you should be able to see here, this is the futures, not the cash market, the futures. And of course, we did come down yesterday, but we had quite a lot of volume on the down move there. So let's bring Tom in, and we'll start the day with Tom's view of the S&P, and then we'll bring in Dr. Gary, who's got a couple of presentations for you, which I know is going to solidify everything we've talked about. I have, yeah.
Yeah, thanks. Thanks, Abby. Yeah, hi everybody. Tom Williams here. Lovely to talk to you. Good morning to you wherever you are in the world, as Gavin would say. Or good evening. Right, if you're in Aussie or somewhere like that. But anyway. Okay, now. Okay, I'm looking at the daily chart of the S&P 500 futures market. And don't forget that this will run in harmony with the other main indexes because of the arbitrage traders. That's their job. That's how they make money. They watch for one to go out of line with another, with one other, and they will buy one, sell the other immediately, and make a small profit from a price difference. That's roughly how they make their money. And I know they patrol the floors of the exchanges looking for opportunities. And the only reason we can't do it is because to accomplish this, you have to be prepared to do 5 or 6 or even 10,000 contracts to make it worthwhile. But, okay, now, so I'm looking at the chart, a daily chart of the 500, S&P 500, and Gavin's got the chart up, and you can all see that, can they? Yeah. Okay. Now, immediately you can see we're in a downtrend. right? We got lower tops, Gavin, here, lower tops. Okay, so we immediately see where it is downtrend. We've fallen down through the lower trend line, which makes us vulnerable to some sort of automatic up move, right? Vulnerable, that's all. Vulnerable for that. So we've got to keep that in mind. Now, I mentioned this several times, as you know, I do a seminar in the newsletter. And when that bar there, look, happened, it looks almost like a gotcha bar, one of Gavin's gotcha bars. There, you got that, Gav? But the thing is, traditionally in the market, they will tell you that when you see a widespread down, closing on the lows with an increase in volume as it rushes towards a former area of support. Now it's rushing down there on two former areas of support. First, the trend line you can see, and secondly, to the left, there's 1, 2, 3, there's at least 4 bars there where the market was supported. So traditionally, that is a potential sign of weakness. Okay. Then here we saw an attempt to go up into that, back into that almost widespread down, but there's not a lot of interest on the upside. And then we have another down bar, widespread, just closing off the low with increasing volume. This market at this moment is weak. Okay, so you certainly would not be interested in long positions at the moment. But you've got to be alert because something will suddenly appear to change the picture. I was looking at the 15-minute chart. Gav, can you put that up? 15 minutes this morning.
Yeah, I know. You told me to go short here, didn't you?
Well,
I could potentially short this because that looks like another upthrust for me, but we'll see.
15 minutes. You see, the trouble is, well, not the trouble, but I tend to get up more early than Gavin. And he's busy getting ready, having his cup of tea and showering and one thing or another. But they do, the London traders definitely get going, but it'd be far too early in the market for most of you. Because here we can see, I was watching it, 2 different signs of weakness, look. And there's one there, look. Here, look, Gav.
Yep.
That was the first one I saw. And that's a principle, look. Why? It's an up move, blue bars, and then look at that surge of volume suddenly coming in. One there, 3 bars. Or at least, yeah, on a surge of volume. Okay, so that's supply coming in. That's a professional money unloading. Okay, then on that weakness, the market goes sideways. Look, there's a little test, some sort, right? Because the market's weak, it just goes up a little bit. But then we get what we see an upthrust. There, look, Gav. Now that's a very, very clear sign of weakness. Very clear. The computers.
Weakness 10 upthrust.
Yeah, even the computers picked it up. Press F1. And there it is, dialog box comes up telling you exactly what that is. And we know that's an upthrust because an upthrust will occur after signs of weakness. Well, 1, 2, 3, 4, 5 or 6 bars back, there's a high volume coming in, or even 7 bars back. There's a high volume coming in on up bars as they unload. Okay, so they go sideways, then they say, right, I think we're ready to let this fall now. We'll have a nice little upthrust, catch as many stops as possible, mislead as many people as possible, and that's how they make their money. And whenever you see those upthrusts after a sign of weakness like that, that's a genuine upthrust and a genuine sign of weakness. Okay, and then the market falls, and it's just rounding over slightly. There's not a lot of selling pressure at the moment on the low of this chart here, Gav.
Now, someone's asking, this looks like an upthrust at the right edge of the chart. Would you short there against the trend?
Well, it's certainly, it's probably no demand.
No, the volume's too high, since it's an increase. Volume would be less than the previous 2 bars on that last bar.
Well, that's true. That's, I'm glad to say you're all learning all this stuff. Yeah. And the bar hasn't finished yet, look. It's true. But there's not a lot of pressure on that market. If you go look back 3 or 4 bars on down bars, there's not a lot of selling pressure on the downside. Especially on that bar there, look at that black one. So, okay, it looks like a weak bar, but of course, if you're paying attention, you should have shorted way up top there, which is very easy to see. So I was sitting here watching it.
Can you just point out, I'm now pointing out the old top to the left.
That's right. Very easy to see this.
Okay, I'll bring Tom back in a sec. Yeah, just so you all know, I'm looking at yesterday's price action. So we went from 14.14 down to 14.02, so quite a decent down move. Overnight in the Globex session, we've staggered up, and we're back up to this old top, but we're up thrusting it. Now, if we go back up there on no demand, even if the trend is up, you've got a choice to make. Do you want to see if you can take a short, or do you want to wait for the market to begin another trend down? At the moment, sorry about that. Let's just do a sound check. It looks like we lost completely the audio and the video there on the internet. We just completely had an outage. Can everyone hear me? Okay, sorry about that.
Yeah, you're back.
Can you I can hear you, Gary. Yeah, we got you, Gary. Sorry about that. We'll bring you in a second. Yeah, my computer, unfortunately, I've got this very top of the range, very nice, expensive Sony computer, which doesn't work. It keeps like stopping. So if it goes out again, Gary, just take over. Don't worry about me coming back in for the moment. But anyway, I'm going to restart the Trade Guider program, and we'll just finish our thoughts on where we're at right now. Now, the question came in, and there's several questions came in, which I'd like to answer. Alan said, okay, let's go back and read that, because I saw that question come in from Alan. Okay, Alan says, as getting out of a losing trade is so critical, could you, Gavin, give us an example where you went into a trade and came out only later maybe to go back in again? Sharing with us your mental process during that period. Is it your stop loss go automatically, or do you get out manually if you see a direction shift not in your favour? This is the weakest link, and I would like to master it with your most valued input. Okay, Alan. Well, the trade that I took the other day in front of all of you was the Aussie dollar trade on Tuesday, and I was short, and I was intending, as you all heard, to to get out of that trade and basically, sorry, to stay in that trade long term for a few days, because I thought the market was going to break its key support level and keep going. However, things did not turn out that way, as we now know. Okay, let me just set the recording up again, and we'll record now. Okay, so welcome back. Sorry about the interruption there. You'll have a chart shortly. The question came in from Alan, and it's a very good question about where do you actually get out of a trade? What's the mental process that you go through? And I'm sure Gary can talk about this as well. When you're in a position and then you look at the market, you look at the charts, and then suddenly you decide to get out of the position. Now, Gary is going to be the best person in many ways to discuss this, because he carried a trade for over 48 hours in Australia when we were together. And there were times when the market was going against him, but he decided to stay with the trade and actually got out right at the right time. Now, do you ever know when is the right time to come out of a trade? Well, let's just have a quick look at what happened on my Aussie dollar trade. Now, you'll all recall I did forecast that the Aussie dollar would go down to 1.0200, okay, and it actually made a low of 1.0191. And you will also recall that I shorted an upthrust on Tuesday, so that would have been in here. So I caught a piece of this move. This is an hourly chart. I was trading a 15-minute time frame chart. Now, what we see, can everyone see the Aussie dollar 1 hour chart that I've got up here at the moment? Let me just close this down. Can everyone see this? This is the Aussie dollar, and it's the hourly chart I'm currently showing you. Good. Okay. So I traded in this area. Now, look at this hourly chart. Few things happen. As we come down into this area, the volume gets higher. Doesn't get lower. Now remember, professionals buy into down bars. Okay. Now, yeah, Morris, I'll get Tom to answer your question in a second. I did see it. I'm just going to talk about this particular setup here. The reason I changed my view of my short trade was this bar here was what we call a shakeout on the hourly chart. The very next bar, we had more strength coming in, but then the market changed behavior. Now, at this point, I'd already used a trailing stop. So my stop was on the far H, and I moved it to the lower H. That's what I actually did. And as it happens, it was a good move because I was stopped out, and the market then went rapidly up and would have cost me money. So I was able to take profit. And I did the same thing live in front of you. Not once, but twice. I shorted, but because I got to this round number, and these round numbers definitely mean something. They definitely are seen by the smart money. The smart money most definitely see round numbers. Okay, and they see these round numbers for a reason. Okay. Now, the market changed behavior, and it changed its behavior on the hourly chart. It didn't change its behavior on the trade guide, the trending system, till here, which would have been too late. But I went down to a 5-minute chart and looked at the 5-minute chart, and of course the 5-minute chart began to turn green, diamonds, strength was coming in, and I looked and decided at that point, my thought process was, I'd rather take a little bit of the trade and get back in again if I see another principle of weakness. Well, nothing came in. The only sign of weakness that's made any sort of sense to me is up here, but I think we're going to break out. I think we're going to go higher today. I think this market's ready to go up higher. So I'm looking to go long, actually, on the Aussie dollar, which I'd be interested to see what Gary's got to say. Okay, let's go back and look at some couple of questions before we bring Gary in here. And there's some questions for Tom. What would you want to see for a bus to arrive for a short on the daily? Okay, that's a good question. Right, and why, Tom, on the daily chart of the S&P, was this bar here not absorption? 7 bars back, 1, 2, 3, 4, 5, 6, 7 up here. Well, it can't. That wasn't absorption. The volume wasn't high enough. But let's go and have a look at that particular. Yeah. Yeah, let me bring up the chart, and then we can go and answer that question before we bring Gary in. So the two questions that came in was, if we go 7 bars back here, which I think is up here, or even up here, why are these bars not absorption volume? Well, they can't be now. We know they're not, because the market's fallen. And what would encourage Tom now to go short in this market? What signal or what bus would arrive for Tom to start looking for shorts? Personally, I wouldn't look for a short myself at this moment, because we're still in an uptrend and we're now outside the bottom of the channel. And we've got an increase in volume on these down bars, so we've got to be very careful right now. There's nothing obvious, in my opinion, on the S&P that would make me rush in at the moment and do something, but we'll see what Tom says. Tom, 2 questions from Morris. Why is that bar 7 bars back not absorption? And I think I know the answer to that one. And what would you look for now to be interested in actually taking a short on the S&P?
Well, we are below the trend line, which does make it vulnerable to a bouncing effect up. So we've got to be aware of that. But what I would do, I wouldn't touch the daily chart unless something very obvious appeared. With these daily charts, sometimes you do see an obvious time that you can trade. But most of the time, the more obvious signals are in these lower time frames, like the 60-minute, or as we showed you on that 15-minute chart that was unfolding earlier on.
Let's have a look at the 15, because Morris said, could we look at the 15-minute chart?
Sure.
Now, I think Morris is asking actually on the 15-minute chart, how do we know that this bar up on the 15-minute chart, the high volume bar, I think that one is what Morris is referring to, I believe. How do we know that's not absorption? Because it has been tested and the market is trying to climb again. And you did mention that there was a test on that black bar there.
Yes. Yeah. So, yeah, right.
Yeah, okay,
so,
Morris, I understand, Morris. So this is the chart that Morris was looking at, and he's asking the question, how do we know at the moment that this bar back in here, the high volume bar, isn't absorption? Because it could be. We don't really know yet.
Well, it certainly doesn't look like absorption volume to me. I can't see if there's anything to the left. Is there a top to the left?
Yes, there is. There's a definite resistance line on the 15-minute chart.
On that level?
Yeah, the market's hit that level 3 times, Tom. Sorry, let me just repeat this. The market's hit that level 3 times and rejected it, and now it's back up there. And I'm just showing the audience where price was rejected. Up here, look, once, twice, and now we're back up there on the upthrust. And it's trying to go through it a 4th time.
And also, that widened at a break up to the upside. But look at it, it's closed in the middle, look.
Mm-hmm. Yeah, it has, yeah.
If they're pushing up through supply to the left, first of all, there would be a definite top to the left, and it will close on the high.
Yeah, this is what you're saying is closed in the middle, and then we've had 2 upthrusts. It's right on that line. Yeah, and we're going up there again right now. We're having another look at it.
Yeah, the market's going up at the moment. There was not a lot of selling pressure on the low there, but to go up through those 2 signs of weakness you see to your left, that would appear to be definitely a distribution area there. They're going to have great, great difficulty. I would say it's impossible to go up through there. If this has probably just been marked up, it'll probably finish up on no demand or something, and that's liable to come off again. Okay, but that's definitely a distribution cap to the left. There's no question about that. And the reason why that will be a serious sign of resistance, because if they've distributed up there, a lot of the pros, then they've got to buy it back. Now, admittedly, this last little dip down there, right, there was a test, and there wasn't a lot of supply, but there's no indication of buying. Where's the stopping volume? Where's the heavy volume on the downside showing they're coming back into the market? That's not there. They just, not a lot of pressure on the market at that moment, and that's allowed it to go up like that. And the professional money, they need movement. They want this zigzagging up and down like this because they know that's the way they can make money. But that's definitely a distribution area to the left. And now it's been marked up there into that area. The volume is quite low, I think, Gav?
It's not that high at the moment, but we're not in the US session yet.
No. Oh, well, no. Yes, but the London traders trade this, and you've got to respect them because they're quite capable of shifting this market, always by the look of it. So, but when the S&P opens up in America, then of course all hell breaks loose, and you get this huge surge of volume, and then you have to reanalyze it. But be very careful about trading at the opening, because they traditionally whipsaw the market, especially if there's some news. But right at the moment, that market to me does not look strong at all, although it's going up like that. But the reason is you've got a distribution area to the left. And I'll be very, well, I'd say it's virtually impossible for that market to push up through there. If they were going up there, there'd be some buying at the bottom, which doesn't appear to be there.
Well, there is a shakeout on the 15-minute chart that you're not seeing. Just so you know. A few days ago, right here, look, you've actually got 3 days ago a massive shakeout at the bottom.
Yeah, but we're talking about the latest reason.
Yeah.
That area there.
I agree with you. I think we're defining a trading range at the moment. There's a definite there's a 12-point trading range that's been defined in the S&P, which is why some people are finding it difficult to trade it.
No, it's fine. Gavin said, oh, there's a shakeout. That shakeout's a way back. But that shakeout has been overridden by the distribution cap that we saw this morning in the London market on that 15-minute. That's traditionally distribution going on, selling. Now, how much, we're not quite sure. But it's certainly enough to make the market a weak market at that moment.
Yeah, and just to, before we bring in Dr. Gary, I just want to show you something. Some of you have said it's been difficult trading the last few days. Sure, it has, because you're defining a range here. This is what we call churning the market. This is a battle between the bulls that are trying to keep the market supported and the bears that are capping it. So yeah, it is in a trading range, and sometimes these ranges are more difficult to trade than when we get a defined trend. We're actually in a long-term uptrend and a short-term downtrend. That's what's going on. And I'm sure Gary would agree with me that these range-bound markets are a little bit tougher. Now, the questions come in from Graham. Would you ever go short in anticipation of an upthrust? And the answer, Graham, to your question, just so Tom's already answered it, but would you go short anticipating an upthrust? Well, no. Because if I'm short here and the market upthrusts, the first thing it's going to do is go up. And I'm going to be under pressure. My account's going to be going negative as I go up. So no, I'm short after the upthrust, not before. I certainly wouldn't. And now, good question that comes in. What happens if the market goes up to this red line on no demand? Would you be allowed to take a trade with a tight stop, a very tight stop, just a few ticks above here? Well, my trading plan doesn't allow me to trade against the trend of price, which has been up for about 8 hours. But Tom will very often ask me to take a trade to the short side, even though it's against the trend there, if he sees a clear principle. So if this was upthrusted on massive volume, or we got a no demand bar with the next bar down on the 15-minute chart, if you want to put your money at risk at that point, you could do, based on the VSA principles, because you've got a clear, defined resistance level to the left. How long does it take for one principle to be overridden by another, says Brian? Depends on what time frame. Now, I'll give you an example, Brian. I was trading the 5-minute chart of the Aussie dollar, and then I went to look at the hourly chart to see if I could carry my trade overnight, and suddenly on the 5-minute chart, I saw a shakeout. The 15-minute chart said strength coming in, and then on the hourly chart, we started to change behavior. The market began to go back up, so I closed my position for a profit. It's very individual decision-making. Remember that. What you're doing, and I know Gary will probably enlighten you a bit more on this, is when you push that button and you're in the market and you've made a decision to take a trade, it's then down to trade management. Okay? It's down to how you want to manage your position. And it comes with, it's a skill. It is definitely a learned skill. And Dr. Gary, as I say, is very, very good at managing trades through and not getting emotional about them. So Graham says, okay, so I always need to follow the principles regardless of the resistance levels. Yeah, look, this market could very easily, I mean, Tom's saying it's impossible to go through here. I don't agree with Tom on this one. It's very possible we'll go through here. And the reason I think it's possible is I've got a shakeout a few days ago. It's been tested over here, and we are pushing up. Now, it's impossible to go through it at the right edge of the chart if we see no demand. I agree with Tom there. As we are looking at this chart, it's unfolding live. But I think that whilst we've got a defined resistance level that has been rejected only 2 hours ago, as the market fell, look at the narrowing of the bars and look at the volume. Now, if that's a weak market, you'd expect it to fall further. It didn't. So we're setting up for a decent move. At the moment, I wouldn't be long or short on this market. I'd be patient. Personally, I don't know what Gary would think. We'll ask him in a minute. Morris says, when do I use Tom's trending systems versus the H-stops? I use both. And an easy way to use the trending system, by the way, is to just switch this bar on here. Just click on Trade Guider, and you'll see you've got, if you look at the simple trending system on the 15-minute chart, up bar, up bar, up bar, up bar, up bar, one down bar, one level bar, one down bar, one up bar, down bar, down bar, down bar, third down bar tells me the market's trying to change behavior. But what happens? This gets tested and we push back up. I would not be surprised to see another upthrust here, actually. And in this case, Tom's trending system on the smaller time frame may keep you in a trade, but we're in a trading range. Remember that. You know, it's a defined trading range. We've got a definite resistance level at 14.15, and we've got a support level down there at 14.02. And it's what I call ping pong. The market is ping ponging. It's making up its mind. And we will get a movement. And when I see the movement, I'll make money. At the moment, though, I personally don't like the look of this chart from a trading perspective. And I don't know what Gary thinks. I'll ask him in a minute. But I personally would not be long or short at the moment because I'm not sure about any principle here other than I've got resistance over here. And if I see a clear principle up there, you know, ideally, here's what I look for. If that market surges through and closes on the low on massive volume, an upthrust, and then we break the low of this bar here to the left where we originally found some support, or even here, and start to break, I know we've got a good chance of getting to 14.0750, and I'm going to get short from 14.11. I can take 3 points out the S&P today, and you may see me do that. So Terry says, on that ES chart, why does the volume dry up on the up moves but appears massive on the down moves? Well observed, Terry. Yeah, it is. It's going up on low volume bars. The moment we're going up, look at the volume. It's still not lethargic, though. It's an effort. It's trying to go up. It's trying to go up. Okay, so let's ask Gling says, can you please share with us, aside from letting the stop get hit, if ever, how to recognise that got on the wrong bus? If you get on the wrong bus, it's very simple for me, Gling. I look at my trading dome. I've got 2.5% of my capital at risk, and if it starts to approach 2% of my trading capital, I'm wrong, and I'll have to get out the trade. I know Gary's very good when it comes to trade management. So let's bring in Dr. Gary Dayton. Now, Gary's giving his time today to help you all. Gary has not only been trading for a long time, he's a very experienced trader. He's also a doctor of psychology. And the reason I wanted to involve him in this course, and I know it's Tom's mentorship course, but both Tom and I know Gary very well. He's participated in a number of our live events. And I know that some questions came in yesterday about what does each individual bar mean in comparison to other bars. And Gary is a genius at discussing that. So, ladies and gentlemen, would you please give him a warm welcome, Dr. Gary Dayton. Gary, over to you.
Hi, everybody. Let me just do a very quick, everybody can hear me, right? Do a quick sound check. Good, okay. And let me just give you a very quick version of my background. I'm a psychologist trained in clinical psychology, which means, working with people with mental disorders. And I worked in the VA system, the VA hospital, the veterans hospitals here with veterans from the Gulf and Vietnam Wars quite a bit. My specialty was in addiction psychology, addiction medicine and addiction psychology. So I did a lot of treating of people with heroin and cocaine and alcohol problems. But I was never really all that good at mental disorders. I was more interested in human performance. And I also I worked with the current sports psychologist for the Cleveland franchise, the Cleveland professional sport franchise. That's the Cleveland Indians Major League Baseball team and the what's the basketball team? God, I forget because I'm not a basketball player. But anyway, you get the idea. And I've taken a lot of that information, or I'm taking it now and applying it to trading. And I also am a trader. And it took a long time, no question about it, a very long time to get my sense. Can you hear me okay? Is the volume all right? I can turn it up a little bit.
Yeah, it's fine, Gary. We can hear you.
Okay, good. It took me a long time to get to be a decent trader. I started off, Ken Roberts actually had sent a brochure and I read it and I took his courses and lost money. Then I got into Elliott Wave analysis and hired somebody who was working for Robert Prechter at the time to teach me Elliott. And I lost the most amount of money in any one trade in trying to make that work. I went into Linda Ratchke's chat room for a couple of years and could see what she was doing, and a lot of my work is influenced by her, to be sure. And she's a Wyckoff trader, and one day I met her at a Traders Expo, and she said, because I was talking to her and I said, I'm really struggling here, and she said, the thing that you probably need to do is to study Wyckoff, because that's going to teach you 90% of technical analysis. And that was true. In fact, when I was trading without understanding Wyckoff, what are you doing here? Oh, you're doing infinity. Okay. Somebody said, every time I take a long trade, the market goes south. Yeah, I had that experience too. My sister was watching me one week. She was down, or she was up actually. She lives in Florida and I live in Connecticut. And she was up watching me trade, and it was at the time that I was struggling, and I just couldn't make it work. Every time I went long, the market went down. Every time I went short, the market went up. And she said to me the same thing that I forget the person's name that trader said. If you think the market's going up, you should go short. That's what she told me. That's not a heck of a good trading system to use. So it is difficult. And the analogy I use, it's like playing in professional sport. When we're trading against the market or trading in the market, and Gavin made an interesting point. He said people think the market's there for their benefit. He said that numerous times, but it struck me this morning. It's not there for your benefit. You're there for the market's benefit. Okay, that's the way this is structured, and I think Tom will say the same thing. The average trader is there for the market to take your money from. So, why? Because there's professional traders who are very skilled at this, and they know exactly what they're doing, and they're trading in huge size. And when they do that, they can manipulate the market on a short-term basis, and maybe even on a long-term basis, for all we know. I don't really know. But they do that, and in fact today is going to be a good example, I suspect, of that, and I'll talk a little bit about that in a moment. You need to really develop skills, and Tom will say this, Gavin says it almost incessantly, and I do too. It's not enough to take a mentorship course or a weekend seminar or read a book and then go in there and expect to be able to trade the markets successfully. That's crazy. It would be like me. I'm a tennis player. People who know me know that I really love tennis, and I play it. And I'm a decent player on a club level. in my little circle of excuse me of players, I'm pretty good. But I can't compete at the Australian Open or Wimbledon or the U.S. Open or the French Open. I can't compete at that level. If I thought I could go in and play against those players, I'd have my head handed to me. And that's really because of why? Is it because I'm no good and I'd never be good? No, that's not it at all. I'm probably too old for that, but if all other things were equal, I haven't put in the practice. I haven't been coached. I haven't learned how to really do it. And that's the same thing in trading. This is a performance activity. You're performing. You're performing against the market and you're performing against yourself. It's not quite the same as a sport where you're competing against other people. But in a way it is. You're really competing against other players in the market. And that's what we want to do, is we want to make few unforced errors, and we want to capture trends when they occur. So it took me a long time, but it was when Linda Raschke said to me, go read Wyckoff, I did. I took her advice because she's a great trader. And that's what started me on the journey here, and that's what really turned my trading around. And believe me, I didn't just read the course once. I read the course several times. I got a hold of Tom Williams's book at one point. Somebody suggested that. It was called The Undeclared Secrets That Drive the Stock Market. I thought it was the best thing that's ever written, and I still think it's the best thing that's ever written. It was an incredible eye-opener for me on how the market worked and how to begin to read price bars and volume. Okay, and it was at that point that my ability started to turn, and I started to become first a break-even trader. I wasn't losing huge amounts of money, and then a slightly profitable trader. And over time, I was able to develop the skills needed for reading the price bars, reading the volume, understanding the structure of the market, what's happening in the background, being able to manage trades successfully. When we were doing that Australian trade, several people came up and said to me, gee, somebody said $200 in profit, why don't you take that? Somebody else said, gee, you got $3,000 in profit, why don't you take that? Well, because the time wasn't right to exit out of that trade. I said that if I did that, I wouldn't be following my process of trading. And I've developed the process over the years. That's really important to me. And it's important to any trader because what we're doing is we're dealing with a probabilistic field. Not every trade is going to work out. Even if it looks the same as the successful trade that happened last week, it's still just a probability, and we have to understand that. Gavin, I can take the controls, right, and put my charts up?
Yeah, I'm going to give you that now. FYI, we're just looking at the resistance level now on the S&P. There's been a surge in volume. We've got a hidden upthrust, and now we're looking for no demand, and we're seeing Tom's ready, if that happens, to take a small one-contract trade on my account. If that happens, and if it does, and we change behaviour, we may well trade it. So just to let you know, and by the way, Gary, I'm giving you now the screen, so you should have the screen.
Okay. And Gavin, I've got you know me, I've got tons of charts to go through. So, and I will go through them, but just stop me at any point when you guys want to take it back, or when you've got a question that you want to ask, and I'm not going to be offended by that, okay?
Yeah, okay, mate.
All right. Okay, can everybody see this screen? Let me just get that. Can you see the screen that I've got up here? Okay, good. All right. So look, let's just focus on the dark chart here. Forget this one over here on the right-hand side. Let's just focus on the left-hand. I posted this up on my website the other day. Here we made the September high at A. Look at the volume that came in here. This was in the middle of September. We hadn't seen volume like that since the beginning of August. So for a month and a half, we get all that volume. Look at where this bar closes, and also look at the range of this bar. And I'm going to go quick, by the way, because I'm not going to. I'll answer any question you've got, but I'm going to go through this fairly quickly. Just jot down notes. Look at the range on this bar compared to the range here. We moved up on light volume on this bar, right? And here we move up and we make this kind of range. Suddenly we get volume that towers over everything else, and the range or the spread is only half. Why? Because somebody's selling into this. Certainly there's buying going on. Certainly there's buying going on because the market held a higher low and it pushed up above the high of the previous bar. But look at the close and look at the range. Two indications, excuse me, two indications that selling is coming into this market at this point. Do we short the market here? No, of course not. It's just we see this happening, okay? And we go sideways for a little bit, and look at the struggle that the market's having trying to go up here on all these bars. Every time it goes up, it comes down and closes low. Every time it goes up, it comes down and closes poorly. It dips down and rallies up, but then we get up above this level, this hidden up thrust in here, and what happens? It closes poorly. And then that turns the market down. And look at the spreads we get coming down. Pretty nice, right? Suggesting, remember, Tom says that spread is equal to activity. Volume is an indicator of activity, but so is spread. Here we see the activity going up. There's a lot of good activity going up to the upside. Suddenly, there's a change in behavior. We're going down now, okay? So we come down to B, the market finds support here, not surprisingly, because we had some support over here. I'm a big believer in support and resistance, not believer, big trader of support and resistance. Not just blindly going in and saying, okay, well, here's support, let's go ahead and buy it. I'm watching very carefully the price action and the volume action on those levels of support and resistance. Okay, so the market stops here and we start to rally up. What's the character of this rally? Not very good, is it? We're chopping around in here, lots of price bar overlap. We come up here, then we come down, we come up, we come down, we come up. And now we start to move up on these last couple of bars before C. Look at the volume on that. Nothing to write home about, not real heavy volume coming in, right? Big volume here, big volume on A, nothing coming in here, okay? That warns us in advance that there's a lack of demand here. These are no demands coming in, okay? No demand coming in. So we get up to C, and look at what happens. Look at what happens on this. This is the same level as at A over here, where we saw supply initially exert itself. Now on C, there's a couple of things. We get a small increase in volume, not much. It's still no demand to the upside. But look at what sellers do. They see that lack of demand in a supply area, in a known supply area, and they bring it down and they close it even with the bar before. It's a level bar. But really, it's weakness. It's weakness. We try to rally up above this level, and we fail. It's an upthrust of that, if you will. We come down again, and look at the volume picks up on the downside, and also look at the spreads. Isn't that similar to here? It's starting to suggest that this is a supply area taking place. We see more selling coming in on the downside than we do buying on the upside. Look at David Weiss, who was my mentor after I read and started trading and was starting to get successful at the Wyckoff method. I got connected with David. I hired him, but he's now my friend, my good friend, and mentor in the Wyckoff method. And he, showed me some of this stuff that I'm showing you. Mine's a blend of, Linda Ratchke, Richard Wyckoff, David Weiss, and Tom Williams. Everyone combined together. Look at how there's ease of movement, ease of movement, ease of movement, meaning nothing more than it's easier to move the market down than it is to move the market up. That's struggle in here. Struggle to go up, easy to go down. But the market finds support. Look at the lows here. This is what we call shortening of the thrust. We try to go down, but we can't do it, and we spring. And I'll talk about springs a little bit later. We get no increase in volume to the downside, and we spring this market here. So, okay, so the market's going to go back up. This is a good tradable event in here, this spring, and the market rallies. But again, look at what happens. We do get a little ease of movement going up here, but suddenly back in this same area of supply, what happens? We had shortening of the thrust, meaning it's hard to move the price down here. We move a little bit down. We come down easy here, hard to come down, hard to come down, hard to come down, and rallies back up. Now we have the same thing on the upside, shortening of the thrust. We have thrust up here, less thrust, even less thrust here. And look at E. Look at the volume pick up here, and what's the close doing? It's negative, right? Suggesting that the market wants to go down. And then the bar after E, we get that pickup in supply. And that's coming in. Let's go now to the main chart here. That's coming in on this bar right here. Has to stop. That's coming in at this bar right here. And Tom showed you this earlier, that it's coming in at a support level here at 1416, and also on a demand line here, this green line coming in. And the odds are good when we see big volume like that come in. Just change the pen color here. When we see big volume and widespread approach a support area, as Tom said, that indicates that that support area is likely not to hold, likely to break down. And that's what we've done. We've broken down here. And here's where we are now. And what I'm looking at is we've got resistance at 1416. This is, the low of a few days ago, and we have resistance a little bit higher up at 1424. Somewhere in here, I put this little box in, is probably what they'll do today, or maybe tomorrow if it rallies up. Push it up. Hang on a second. Pastor, what's the matter? What's the matter? You can't do that. No. Stop that. I'm in a thing here. That's my dog. Sorry about that, everybody.
Is that your dog, Gary?
Yeah.
Hey, Gary, ask your dog what the S&P is going to do.
Yeah, is it going long or is it going short? Huh? Which is it going to do? As to say short. So, and yet here on just this little other chart, and I'll explain these a little bit later. This is a tick chart. But you can see, and the days are highlighted here in these vertical lines. So here's yesterday's high, okay? And the S&Ps, boy, oh boy, they do this all the time. It wouldn't be a surprise for me to see the market push up thrust this high from yesterday, and then fail here, and then come down. But anyway, that's the current market as I see it. And maybe we'll get a trade here. You thought that was my wife, Graham? No, she doesn't scratch at the. But anyway, we saw this the other day. I posted this the other day that we were overbought in the trend channel. This is a daily chart here. We're back on the daily. And this is a wave chart. David Weiss will come in tomorrow and explain this. This is his work. And we created this trading range in here. We've fallen down into this area. And it wouldn't be surprised. We're going to talk about this falling through the ice, the support, and then coming back up, bumping the head on the ice and falling down lower. That's what I've been anticipating here. And this was posted, you can see the date it was posted a few days ago, just looking at this. Okay? All right, so anyway, let me see. What am I going to do if I close this off? You still have my screen, right? Let me see. I've got to see what you're seeing. All right. So let's do some bar-by-bar analysis. This is what I did in Asia from the beginning here. You can see that, I guess, right? And we'll just go through taking a look at bar-by-bar, and then we'll look at setups like the spring and the up thrusts, and the fall through the ice and the jump over the creek. These are classic Wyckoff trade setups. But you need to spend a little bit of time figuring out bar by bar. So we'll take a look at several charts. And Gavin, just jump in and say that's enough. We'll look at tops and bottoms on a bar by bar basis, where we can initiate trades. And just sort of, this is just an introduction to Wyckoff analysis. And I'm going to make it sort of simple to begin with because I want you to see this, and I want you to understand that things can be read bar by bar. And for those of you who've got the Trade Guide or software, it's a real blessing that Tom computerized all this. I didn't have this when I learned it to begin. When I first started to learn it, I struggled, just with price bars and volume. But you've got those dialog boxes and those signals that pop up, or indicators, as I tend to like to call them, that pop up. And you got a real leg up, so you can use that. But let's just take a look at this market, and let's just see what we can see. Well, we're coming down here at 1 and making lower lows in here, right? Not a lot of volume on bar 1. We try to rally up. We can see some buying came in and in on bar 2. We get an increase in volume, and the market dips underneath the lows of the day before, actually a couple of days back. Finds support down there, doesn't find selling, and it rallies up and closes firm. But notice what happens. It's similar to what we just looked at. When we get up to 3, we have lack of demand on the rally. We up thrust. We push up above the high of this little range in here. Little increase in volume, not too much, and the market fails there. And so we start coming down. And just as we said before, we hear widespread now coming down. It's easier to move the market down. We don't have bigger volume coming in. But it's very similar to what we just saw on the current S&Ps. We get down to that support level here. We try to rally up. It looks like it's going to hold, in fact, but instead it doesn't. It comes down to 5. All right, what do you all notice on 5? What happens there on bar 5? What do you notice on bar 5? That's this bar right here. High volume, right? Higher volume than anything we see on the chart. Higher volume than anything we've seen on the chart. We're pushing down, right? The spreads are pretty good. There's ease of movement coming down here on these 2 bars. Ease of movement. It's easy to move the market down. We see a little bit of a narrowing of the spread here, and some buying coming in the late afternoon. But if I were reading that real time, I would say I'd be certainly aware of this volume and understanding that high volume, I'm probably near a turn in the market. But, at least for some sort of a rally. But I would have to say that sellers are still in control here on bar 5, right? Stopping volume, maybe the beginning of stopping volume, but I wouldn't see it as stopping volume yet. Tom may differ with me on this, but I don't think he would. It's the next bar that dips underneath, let me erase this, that dips underneath the low of bar 5, finds no further selling down there, and rallies up and closes well inside the range of bar 5. Now I can see that this is an indication of stopping volume. Okay? We rally up, and we come up. We push up above the high of bar 5, all that volume. That's saying to me that buyers, and we also gap open here, right? This is an ETF of the Russell 2000. We gap open, and it says to me that there was buying overnight, and the market is being pushed up. We go into this little churning trading range in here. At bar 6, we see a wide spread up. On the bar before, sellers try to take it down. Buyers step under, they go underneath the low of the previous bar to 6 and rally it higher. But look, we don't get much volume there, do we? Actually, we have a lot of volume going on in here. Look at the volume here. Compare that to the volume over here. This is a skill that's really important, to be able to take a block of volume like this and compare it with the average volume that's been occurring recently. Okay? You'll see this on every market turn. You'll see stuff like this, bigger increase in volume on virtually every major market turn. Okay? So we don't draw out more demand. At 7, we can see the classic no demand bar, narrow spread, up bar, closing here on its highs, but on extremely low volume compared to what's been going on the last week and a half. The next bar, 8, rallies up above that no demand and closes it down. And we have widespread ease of movement down, increase in volume over 7. Now we can say pretty surely that the odds are good that we're going to go back down and either break down through below 5 or at least test it. Okay? And we do. We come down to 9, but look at the volume here. Look at the volume. Compare that with what we saw over here at 5, the bar before 5, the bar after 5. It's underneath all of that. It's underneath all of that. What happened to our sellers? What happened to our supply? Okay? There's no supply. That's right, Joyce. There's no supply. No supply. Lance says bars 6, 7, 8 are irrelevant. No, not really. Not really irrelevant, because we've come up on 6. We've come into what had started to be a little bit of support in here. Now will be resistance. But we were able to rally all the way up into there, and every time sellers tried to take it down, buyers stepped up and pushed it up into that area and went deep into the heavy supply that we saw. So really not irrelevant at all. No bar is really irrelevant. They all tell a little bit of the story. They all work to tell a little bit of the story. So anyway, we come down to 9, and what happens at A? We get even bigger volume here. We dip underneath 9, and we come back up. And if you were watching this intraday, you might have gotten long on the rally above the low of the day before, above bar 9. And now, for the first time, look at what happens. We close back up above the lows of 5. This is what we call a spring. A spring, where the market goes underneath the lows of a support level, finds no further supply down there, and then rallies up. And you might be thinking, well, gee, how come with all that volume on A there was no supply there? Oh, certainly there was a little bit. But my guess is that if you were watching this intraday, you would see something like bar 7 here, really small volume, when we were down below the low of bar 9. And then buyers saw that. There was no...
Gary, there's a question for you.
Yeah.
Yeah, Gary, we've got a question for you from Lance, and let me just open up his mic so you'll be able to hear him. And let me just make sure I can do that. Just bear with me. So there is, so yeah, I don't know if you can see the questions, but there is a couple of questions came in there. But here's Lance to say hello to Gary. Lance, over to you.
Hello, Dr. Gary Dayton.
Hi, Lance.
Hi. Basically, what I just wanted to do was to clear up that's why I said 6, 7, 8 would be irrelevant. I agree with you. No bar is irrelevant when we're trading. However, on bar 5, we see the surge of volume come in. I would then think, what I need to do is I need to draw a line at the closing price and the bottom of that, and when the price comes back down to that area on low volume at 9, that's where my highest probability entry to the upside would be. So for me, 6, 7, and 8 is quite irrelevant for the way that I'm learning VSA. Okay, I agree with you that we've got the support at 1, sorry, the resistance at number 1, which we would keep an eye on. However, because that support's there, I would be expecting the price to bounce off support, come down to 9/8 on low volume for a high probability trade to the upside. That's all I wanted to say, was just why I felt 6, 7, and 8 was irrelevant to the way I'm learning BSA.
Okay.
Might say it just seems to save a lot of time. But that's it. Carry on. Sorry to interrupt.
Your highest probability trade is not going to be at 9, but it's going to be on A, because at A, the market's proved itself and rallied back up above the lows of 5. Okay? 9 tells you in advance that the market might turn because it's lower volume, but we don't know that for sure. And now at A, we have a much better probability because lower prices do get rejected. So that, in my judgment, is your better probability trade. For me, taking a trade on 9, if that's what you meant, that's a low odds trade because you still have resistance here at 5. And what I want to see is the market overcome that. In other words, it could go up on a small volume and just come back down, come off of that. I want to see it prove itself. The demand, the buyers have to prove themselves, and on A, they do. Let's go back to 6, 7, and 8. Compare this, let me try to say it this way. Compare this struggle in here with wide price bars on 6, the bar before 6, and even on 8. They try to hold it up at this level for quite some time. Compare that with the last rally and look at the difference in bars. There's a big difference between these two. And what this is telling me is that there's a struggle going on between buyers and sellers. Here there was no real struggle. Sellers were definitely in control, and they just, the professional side of the market just stopped selling in here and let the market float up to see what was there. There was nothing there. Here, there's this different story. There's a much different story. There's buying going on in here. Whether it will win or lose, we don't know at this point. It's too hard to read this in here. But what I do know is that for the first time, at least on this chart, there's a good effort being made to turn this market. And so I want to be aware of that. Okay, hopefully that helps you in that. Yeah, there's a lot of questions. And where is the best place to buy the spring is right on, hi Terry, how are you? Good to see you. Right on the close of the bar. Or if you're trading intraday and you see the market go back up above the low of bar 9, to buy in here and then see what it'll do. Your next resistance level is going to be the low of 5. Okay. Would A also be called bag holding? Not really. Maybe you'd call it bag holding. It does go into new low ground, and it does have that high volume, and it turns around. So you can think about it in those terms. I just see it as a spring, because what I'm trying to do, Joyce, is try to help you to see the structure of the market. This is a structural point in the market. It's got some support here, and the market's gone underneath that support. So that generally means negativity, right? If it turns around and comes back up above that support, that's positive, and that's what we're seeing here. Okay, so we rally up, and we come up to B. Good. I'm glad you're seeing it. Always enjoying my... Don't springs in a downtrend usually fail? Yes, but there are times when they don't fail, and that's when you have this stopping volume coming in over here. You've got that very high volume, and there's enough going on. It's an aggressive trade, no question about it, because it is still in a downtrend. We're still making lower lows, lower high, lower low, lower high. So it's a very aggressive trade. But it's still not a bad trade to make. Because the market is failing to go down. Now, we may not get much of a run up. We don't know. We have to see that. But look at the rally up we do get. We have that ease of movement going up. Not on big volume, but that's okay. The supply has been taken out of the market, the floating supply on this stock. That's what that signifies. When it just sort of levitates up, it just sort of goes up. And look at this. Higher close and low and high, higher close and low and high, all the way up until B, and suddenly we get the big volume again. And why is that? Well, is it surprising that this happens at the same level of supply that we saw earlier? Okay. At C, we get no demand here. It's not a great example of no demand, but certainly the volume is coming down. As we dip down on D, we get more buying try to come in, but sellers push it down. This is the professional side. Look at this on E. We drive down, but we don't have a big pickup in volume. It's probably more of a shakeout than anything else. And we come to F. We dip down. Now, Gavin will do this. He'll draw a line off of the close of bar 5. And look at what we do here. Look at what we do here. We come down. It sells down in the morning. In the afternoon, it pushes back up. So here is a test. It's a high volume test, but it's a test of all this supply in here. And then the market rallies up. We push up through it and look at the nice ease of movement going up. Okay? Ease of movement, ease of movement. Two indications of ease of movement. Clear change of behavior in this market. And then we get up, we drive up above the highs of 6, 8, B, C, E, all of that, right? And we push up above 1 and 2 over here, the lows. And what do we get at H? Nice little testing bars. Good, also good areas to take trades. So most aggressive is on A, a nice test is on F, and very safe, very conservative is on H for trades. Yeah, Joyce says H is the clear long entry, and I would agree with you. Now, when you're thinking about taking trades, though, you have to do this. This is part of trade management, money management. If we take the trade at A, or especially if we're watching the market and we're able to buy it as it's pushing through the low of 9, we can set our stop pretty tight, right? When we are over here at F, we might, if we're trading intraday, we might take it, in the lower part of A if we see a change in behavior, maybe some stopping volume or climactic action. If I were to draw on the intraday time frame a trend line, I would see that at F I'm oversold in here. And this is one of the skills that is important to develop, being able to read multiple time frames from just one time frame. But your higher time frame here, the lower time frame would be oversold at this point. So you might have gotten aggressive in here. However, if you did buy in here somewhere, your stop still has to go down here. So you're farther away from the danger point. Okay? You now have a bigger stop in here than you did on this aggressive trade over here. Okay? So while this may be more aggressive, from a money management perspective, it's a less risky trade because you're closer to the danger point. If it fails, you're going to have a smaller stop loss, a smaller loss. If this fails at F, you're going to have a much bigger loss, and it's going to be more damaging to the account. At H, yes, this is very good because we now have a higher high and a higher low for the first time, but your stop is going to need to go underneath here. So you've got the widest stop. So you manage that by your position size. You might have taken, 5 contracts down here in the S&Ps. Up here, you might only take 1 or 2. That's a way to manage it. Or you might just decide to, go in with larger size, but if you get stopped out, you're stopped out. You're going to have a bigger loss. So, Samir says, how do you read ease of movement? Okay, look at these bars here, Samir. Look at B and the bar after B. Okay, compare those bars in terms of their spread and their closes not just in relationship to their high and their low, but also in relationship to the prior bar. Okay, compare that to here and here and here and here. Here it's very easy to move the market up. Suddenly we start to struggle. at B and the bar after B. Okay. Compare B and the bar after B with G all the way up to here. We have nice ease of movement going up. Okay. Nice ease of movement. We're making higher lows, higher highs on wider spreads, and we're closing firm. That's nice ease of movement. Okay. Here, we have no ease of movement. None whatsoever. It's a struggle to move this market up. Here, it's easy to move the market up. You want to have a break, says Ron. Time to have a break. TP King says turns the area from bar 5 to bar
10 minutes, Gary. We'll break in 10 minutes, Gary.
Okay.
Just so you know, 10 minutes we'll have a break.
Good. Into an inverse head and shoulders and gives greater confirmation to the head and shoulders with understanding of shakeout screen. Yeah, I don't think about head and shoulders at all. TP, I don't look for patterns like that. I'm looking to read the individual bars here and what's happening in here. And here what I see is that, why do I say that? Because head and shoulders fail all the time. There was a time in early 2009 or maybe early 2010, late 2009, where just about everybody was saying, oh, there's an inverse head and shoulders, it's going to go down, we're going to have the resumption of the bear market. And I saw a spring with a test, very similar to this. This is not 2009, I forget what year this was, but very similar to this. But people saw an inverse head and shoulders, and they thought the market was going to go down. And I said, no, that's not a good way to look at it. So just seeing patterns like that is not necessarily always going to be helpful for you. You've got to be able to read the price bars and the volume. At least if that's been my experience. I was a big head and shoulders guy, all of that, those patterns, pennants and triangles and ascending, I did it all. I looked at all of this stuff, and to me, that was unhelpful. So what I can give you from my experience is that just tell you what works for me. So, as I said before, it helps to read blocks of volume, to see blocks of volume. And here we have a block of volume. Look at how big it is compared to this. This is sort of the normal volume, right? If we were to do an average line in here, it would be somewhere like this. This is much heavier. If we did an average line, it would be somewhere in here. Substantially higher, and the Trade Guider software does that for you. And you can see that we come back to normal over here, right? But it's going to be, and you look on your charts and study this, you're going to see pregnant levels of volume, where the volume swells like this. And almost all the time, that's going to be a turn in the market. Those boxes make things really clear. Yeah, they do. It helps. Okay. How many trades did you execute in the time frame you boxed, and where? Where I said that good trades are going to happen at A, at F, and at H. Those are the three classic places for Wyckoff to make a trade. If you were day trading, it's a totally different story, but I'm just looking at this as a single time frame to use. But you do have to develop the skills to do multiple time frames, as I kind of showed you. We'll see some examples of that. If I entered on A, would I still be holding to F? Yeah, sure I would, because my stop would be below A, and I would see this as not resumption of the new downtrend or new downtrend. And Joyce says sometimes the difficulty stems from not seeing the bigger picture. Well, I would have to agree with that. I would have to agree with that. I'm just going to do really quickly the beginning here of BHP. We notice here that we've got highs and lows and high and low. We're making those higher highs and higher lows. But what can you tell me about I'll just label this here as P to F. What can you tell me about the move from P to F? What do you notice here? What do you notice here? Daniel says, do I place more importance on volume or spread or close? All three, Daniel. It's looking at it, you know, in its entirety, comprehensively. Looks like ease of movement down. Yeah, we get some ease of movement down. No question about that. No question about that. Good. You guys are picking that up, right? Volume receded from P to F. It does. It does get lower in here. We get a little stopping volume right down here. Turning the trend. Notice we come back and we test in here, right? But what's the story here about P to F? What I see is that we have a big swing down, don't we? Compared to the last one here, this last swing down. And if I look, this is the way, I'm giving you sort of an introduction to wave analysis now, right? If we look, we had a nice wave up. And if we look here, we have a wave up here, right? Good wave up. But suddenly, the down wave is bigger than the up wave. Okay? Different way to look at the charts. We'll talk more about that. The down wave is bigger than the up wave. What this says, in just logical terms, is that sellers were strong enough to force the market down a lot longer than they could over here, from P to F, than they could over here. Okay? That's a subtle but important indication that supply has come into the market. Okay? Possible change of behavior. We come up to 1, right? And we can draw a trend channel in here. By the way, I love trend channels. If we were to draw this here, in like so, and we were following this on an intraday, you might be a buyer in here because you see that big volume coming in. It's oversold down here. There might be, you know, a nice little setup, a climactic action with a test on maybe a 15 or a 30-minute chart, or even a daily chart. I'm sorry, this is a weekly chart. Maybe a daily chart would show this, right? We break the downtrend line here. We test in here, and then we start up, and we can do another trend channel from in here and see that we are oversold in the trend channel, and we're at a point of resistance. And we get what we call a top reversal, where the market comes up and then starts coming down. Okay? And then look at what happens at 2, a little hidden up thrust, and look at the volume. It's an up bar. It's closing up above the previous bar. Spread is narrowed, relatively narrow. This is a weekly chart now, right? It's a no demand. It's a no demand, little bit of up thrust. And then I just put the arrows in. Then we see the volume come in, step in, and start to push this market down. Pretty nice, right? And notice here, we've got now we've got bigger waves going down than we have coming up. And we have big volume or larger volume coming down as we approach this low, this support level, indicating that we're likely to find this support level to break. And we do. On 4, we rally up. We have that hidden up thrust in here, or maybe Tom would call this a straight old up thrust on a weekly chart. And look at the volume. It's very light. It's a no demand type up thrust. And bang, we just push right down. Okay. I won't go into this because I know you want to take a break, and I do too. I need to get another cup of coffee. So I think, is this a good spot to take a break here?
Yeah, Gary, it's brilliant. By the way, are you all enjoying this? I've said Tom and I are listening in here in the background. Superb. I think it links in very, very nicely with what we're been talking about from a VSA perspective. And yeah, Gary, no, I think that's fine. I think we should take a break because the trouble is it's so much to absorb that, you know, I'm worried that people will get to the point where they're like, oh, okay. And it was 7 o'clock in the morning out there for you, or 8:28, I think it is, isn't it?
Yeah, it's 8:28.
Yeah, good. Well, everyone's typing in that this is great, Gary. So I'll tell you what, let's do this. Let's reconvene here then. So we've been going now for an hour and a half. Let's reconvene at 10 to 8 Chicago time. There's my clock there. So about 22 minutes time. Everyone can have a nice cup of coffee, cup of tea, whatever your poison is. But please don't drink any gin and tonics or anything like that. And we will reconvene here in about 22 minutes time. So well done, Gary. Great job. And we'll see you in about 22 minutes time.
Okay.
Okay, hi everybody. Just want to do a quick sound check. You should see my chart here of the S&P 5-minute chart. Can everyone see that? And we'll bring Gary back in shortly. Thanks for all your kind words. Malcolm, yes, Gary does teach in the United States, but he's writing a book at the moment, so I know he's extremely busy because he's got a publishing contract. Okay, so what are we seeing here? Okay, what's going on? Well, that is a definite, without a shadow of a doubt, a trap. The question is where they're going to go with this right now. We can quite clearly see that there's weakness on that bar at resistance. That's to catch breakout traders, but we've got a bit of a test, so it's popped up a little bit. But there is a lot of weakness there. Now we want to see the market take out this low. So your key level now, for those of you that are watching this, is here. That is a key level right down here. So it may well go up and test the top of that bar. It's very possible, but you want it to push back down. And once it clears 1411, we would very likely see lower prices there, unless they're going to hold this price up. But that, to me, looks like a very weak bar. So, yeah. Now, let's get Tom to look at this and see what he says. This is a 15-minute chart that Tom's going to analyse, and then we're going to bring Gary back in for part 2. And I know you're all enjoying it because I've seen all your comments, so thank you for that. Here's Tom.
Yeah, thanks, Jeff. Hi, everybody. Yeah, Tom Williams here. Right, okay. I'm looking at the 50-minute chart. We analysed it earlier, and we definitely saw what looked like a distribution area to the left there. Okay, and that signals on it. Definitely looked weak area. It came off a little bit, and then because there wasn't a lot of selling pressure on the low, it started to go up 1, 2, went up 3 blue bars, back up near the high. And I said at the time it would be highly unlikely for that market to be able to go up through that distribution area, and we would not be expecting higher prices. Gavin did short the market, and he was clever enough to put the stop well away from the predators. And I was sitting here watching this chart, and suddenly, bang, they marked it up. It didn't go up there, they just marked it up. I saw them do it, and it was only up at that high there for almost less than a second. So they're really, really crafty. They mark it up like that, and if somebody complains, oh, well, the market didn't go up, they say, well, yes, it did. Look, here it is. But it was only up there for really less than a second. I was watching it. And then down. So that's got to look like an additional sign of weakness there at the moment. We could have been on some news, we don't know, but the volume was high, look, on that, which it would be. Now, the market's going to open in less than half an hour, well, 30 minutes time. 35, yeah. Yeah, 35 minutes time. We've got to be careful because we know they like to whipsaw the market. But I would have thought, what with that distribution area we clearly saw to the left this morning, now it crawled up and then they had this deliberate upthrust, obviously to catch stops. That's definitely what it was designed for. It was up there for less than a second. I watched it. It was suddenly like an exploding star up the top there, and bang, came straight down. So there was no movement there, no genuine movement. They just simply marked it up. So they can claim, yes, that's the level it went to. And of course, that would catch all the stops on the upside above the market. Now, if they were bullish, surely they wouldn't do that. They'd mark it down, catch all the stops below the market. So it has to look weak at the moment. And we saw these earlier, the daily chart. we are oversold, so we're expecting a little bit of an up move perhaps, but the general market looks basically weak to me. So we just now have to watch it. Gavin's still short, and what you do, say, right, if I'm wrong eventually, I close it out. If I'm right, I'll let it run down a bit. It's as simple as that. You don't have to be too clever about it, but emotionally it's going to rip your course. We'll just see what happens at the opening, but be careful. They do whipsaw the market.
Yeah, and I've just scaled out part of the position. But let me just explain something. I mean, what we've got here is a distribution line at the top here. I'm sure Gary can talk about this. If this takes off to the downside, and it's all about the word if. If it takes off to the downside, right, that's a great trade. But, you know, here's what they do. If you see a resistance level to the left, most educators will teach you to put a stop a couple of ticks above here and say, well, just put your stop just above here. But in fact, you can see they're devious. That stop here, I use a 17-tick stop. Here, when that market's marked up like that, which it is, it's marked up, they do, and they actually do a 2-point move from the resistance line, because here, from about, what was it, 14.50, so they're using a wide gap up there, and there's a lot of electronic traders and computerized trades that will have very tight stops in here. That is designed to take them out. Now what we've got to look for is no demand. That's what you've got to look for now. Look, on a 15-minute chart, we want to see the market run out of energy, run out of steam. And this market, and I'll be very interested now to bring in Dr. Gary to talk about what's going on here. Gary, can you put your mic on? I'd be very interested for your comments on what you see here.
You know what I see there? Certainly it's that level that we've been talking about. They rallied it up above yesterday's high.
Mm-hmm.
But I think this is the algo trading. There was news that came out, 2 pieces of news, the durable goods order and the jobless claims, right at 8:30 my time, and this is right around that. And I think that they just went up, got the pushed the market up, and that's why you didn't see it. That's why Tom didn't see it. None of us saw it. It was the that high speed or high frequency trading algorithm that kicked in just prior to the news. There was an article in the Wall Street Journal about natural gas traders who would trade the weekly gas inventory, and they say they can't do it anymore because the algo traders are in there, and they push the market just like this. And the gas market, of course, is even less liquid than the S&Ps. The S&Ps is the most liquid market. So, but they saw an opportunity here because the volume was light, and that's what they did. That's my take on it.
Yeah, now, where they're going with this. Now, at the moment, that bar, if that was a strong bar, we wouldn't see it close on the low, would we? I mean, it should have closed up. If that was absorption, we should have seen it close up on the high and be tested. So, at this moment in time, it appears to me that prior to the open, we could have a secondary upthrust. That does happen occasionally. But in this instance, what I'm looking for is no demand at this level, so no more high pushes up, and then a takeout. The key to this trade is to take out the low of that bar. That right. Is when, yeah, that to me is the key level. Now that whole chart to me is key on this low of this bar, not the close. Not interested in that anymore. I'm interested in this bar, this level here. If this market falls through that level, it will collapse. Mm-hmm. I mean, I have no doubt about that. I am so confident that if, and here's the big word, isn't it? The wonderful if. If it pushes below 1411, you'll see probably 8-9 point move down. So I've obviously shorted this anyway because I could see the weakness in the background. The upthrust for me was a good one, but that wasn't enough. But that bar there got me really interested because here, look at the volume. It's higher than all the other bars. It goes up, closes below the previous bar, and then I look at the top of that bar and I say to myself, I see what these traders are up to. They mark it up here, okay, and very high volume, all right, so the volume is probably the highest we've seen in the second. Remember, they sell into up moves, and then they're devious. On the news, they whack it up quickly, catch a few stops, and now we've got to see if the market changes behavior as I expect it to. If it doesn't, you close your trade. If it does, you make a lot of money. Thanks very much indeed. Now, what is a secondary upthrust? Okay, so Gary, here we have an upthrust. Yeah, that looks pretty genuine to me. It's at resistance. I think Wyckoff would have called that a proper upthrust because it's at a resistance level, right, Gary?
Mm-hmm. Right.
Okay, so you've got a nice signal on it. Tom has computerized the signals and said, yeah, that is an upthrust. Okay, what characterizes it? Well, the volume is high. It comes up to that resistance line. I call these trigger numbers, but it collapses onto the low and falls. Pretty much down to where they mark the price down here. Makes sense. Then we come back up here and look at the volume on this bar. There's no signal on this particular note. The computer hasn't recognized the bar, but I can because Tom taught me to trade, and Gary taught me to trade as well. I've learnt a lot from Gary Dayton. And what do we notice about that bar? Well, the volume is higher than all the other bars behind it. Okay, so you look at the average, it's very high. But it closes underneath the previous bar. So that is not a strong bar. Those two bars cannot be strong. They have to be seen as weak bars. But we know news is coming out. So I'm looking at the news story, I'm looking at a smaller time frame, and I see no demand. So now I'm thinking, okay, if they're going to mark this down further for more buying, the first thing they're going to do is get rid of all the traders who have now got their stops close to the market. And sure enough, well, Tom was right. They did. There it is. Now, what we now want to look for is a change in behavior. It hasn't happened yet, but we're looking for it. The change in behavior of this market will be the markdown, possibly at the open, at 8:30, so we're coming into the open, where it comes down below this level. They could mark it up again, but that, is that likely? We don't know. Remember, you don't know. You have no clue at the moment. You know there's a weak bar here. You know there's resistance. Now it's a question of, okay, where they're going with. If it collapses through that low, my belief is that it'll go to 1400, and they'll mark it down to that round number, and I'll make a lot of money. But if it doesn't, then I'll close my trade. That's the way it works. So we've got loads of questions coming in. What if you see an obviously weak bar into the hidden upthrust? Well, I mean, this is not a strong bar, is it? Let's look at the very next bar. That, to me, doesn't look like strength at this moment in time. The market's been moved up, but still there's volume there because we're coming into the open. The key to this is looking at the bigger picture, though, isn't it? We've got some strength in the background. Now we've got a sign of weakness appeared. What we are looking for now to get excited about our trade is to move below the support line. Now, that's the key to this. It has to change behavior. Now, Gary, I know you're going to put your PowerPoint up in a minute, but perhaps you could talk a little bit about David Weiss here. I'm using the Weiss wave on another computer. How does the market change behavior after these bars? Because at the moment it hasn't. But at some point I'm looking for the change in behavior to possibly add to the position or close the position depending on what I see. So perhaps, Gary, you could talk about that, the change in behavior of the market, why we're looking for this support line to be penetrated, and then how we're going to, well, certainly I'm in a trade now, how we're going to manage that trade. So over to you, Gary.
Okay. Yeah, I can just hang on this chart for a second. I can use this. We're still in an uptrend here, right? From the low of yesterday morning, we're still pushing up, making higher highs and higher lows all the way up. And especially since on Gavin's chart here, just before 3 o'clock, maybe 2:45 in the morning, We approached that 1415 high, that 1475 high. We had some weakness come in. We came off of it. Now we've revisited it. Yep. We revisited it. We have this bigger weakness, in my judgment, come in. But Gavin's absolutely right. We need to break the low of this to see a true change in behavior. Because so far, the only real, we certainly see signs of weakness, but we haven't seen the market respond to that in a positive way. And by what I mean by positive is it starts to go down. And what we want to see is breaking that low and starting to go down lower, put in a larger wave to the downside, and we want to see volume pick up. We want to see that ease of movement start to come down. Okay? Until we see that, we're just going sideways in here, and the market can continue to go in the uptrend. The immediate background from yesterday's low is still up. We see the weakness, and we can take a trade here, but this is all about trade management. It's all about probabilities. If it doesn't happen, then we have to take it out. We either scratch out or we take a small loss. But typically, these will work. We've seen, and I think this will go down. There's enough weakness in here to do that. The only thing, that kills an upthrust is it just going sideways. And Wyckoff would call that absorbing the supply to the left, absorbing yesterday's supply at the high. So we could be seeing a little bit of absorption. We have to pay attention to that. I don't think it's going to happen, but it's all probabilities. Okay.
Gary, just one quick point to add to this. Mm-hmm. You're quite right. You just see a sign of weakness. Okay, this one definitely worked. Now, we don't know if this is absorption volume yet. We don't know what's going on. We know there's a sign of weakness there. Markets don't like ultra-high volume bars like this, but it's a down bar. It's not an up bar. It didn't close on the high. It closed on the low. The next bar has still got quite high volume on it. Where I manage the trade is this. I've got my stop right up there, okay, just at the top of that bar. So it's just at 14.16. I've got my target, though, much, much lower, about 14.07. Let me just show you the actual trade so you can all see it. And I've got two contracts on it, so I'm still in the trade here. So I'm just above here. If it goes up, I'm going to lose on my account about 2% because I've been making money all week. I've made money all week. Here, I now know where my risk is and where my reward can be. That's trading 101. Let me bring in Tom before Gary takes over. Tom, now, you and I have traded for probably 10 years now. I mean, I've started trading real money the last 7 or 8 years. And it's all about not being certain about what the market's going to do, but all about risk, reward, and trade management. I'm not 100% right. You think you're 100% right, and usually he's pretty right. But talk about, Tom, how important, and Gary's listening in as well as Mike's open, how important is trade management?
Well, it's obviously very, very important. And I think if you listen carefully to what Gavin says, you'll pick a lot of it up. I'm afraid I'm personally a little bit cavalier. I usually fire from the hip, as they say, and I just simply follow the rules. If I'm right, I let it run. If I'm wrong, I get out. But this upthrust, I was sitting here watching this upthrust. Well, the market suddenly, like a rocket exploding, way up above the chart, bang, and it was down within less than a second. So obviously it was not a genuine up move. They'd simply marked it up solely to catch the stops. And why should they do that in a strong market? If it was a weak market, that's the sort of thing they were likely to do. That's my opinion of it. That's how I would read it. I'm afraid I'm not one of these great intellectual guys that follow the rules and all this. I tend to walk around and fire from the hip, but that's just my style. And it's the protection I've got. If I'm right, I let it run. If I'm wrong, I get out straight away. And but you could listen to Gary carefully, and Gary, he'll tell you more about management than I can.
Yeah, and you know, we talk about managing a trade. Again, you know, you're never going to be 100% right. That's unfortunate in trading. It's the way it is. But everyone wants certainty in life. But we know, and I'm sure Gary can elaborate, that life is an uncertain business. You know, one day things will go great, other days they won't. Trading's the same. And I had to accept that. I actually, my biggest difficulty with trading was, initially anyway, was that I always wanted to be right. And Gary, do you find that as well? So when you start, you think, well, I want to be right all the time. And when you don't get it right sometimes, or you get stopped out, for whatever reason, you start to get a bit frustrated with yourself. And I've learned to get past that. How do you feel about that, Gary?
Yeah, it's basically the same thing. You know, it's natural for us as human beings to want to always be right. That's part of our psychology. And that was, you know, I always wanted that too. I wanted to be right. And I would, you know, sometimes buy in as the market was falling if I was long and try to, you know, maintain a long position and I'd get stopped out for a huge loss. Or I'd hold on to a losing trade and hope that it would come back so that I could at least get out at break even. I was doing all the wrong things. And one day I read a book, I think it was Market Wizards by Jack Schwager. Mm-hmm. And Jack was interviewing Marty Schwartz, who I've never met, and I would love to meet him at some point. He's an older gentleman now. He's well into his 80s, I think. But he's a big commodities trader. And Jack, he went for 10 years without making a profit at all, with, you know, consistently losing money. Mm-hmm. And Jack asked him, so Marty, you're a successful trader now, and you have been for quite a while, but you were a loser for 10 years. What made the difference? And Marty said, when I stopped wanting to be right. This had such an impact on me. I mean, I wrote the quote down and I memorized it. What he said basically was this, that when I was losing, you know, I'd do analysis. I do my market analysis, and then I put a position on, and I would say to myself, you know, I must be right. I did the analysis. Now the market needs to go in my direction. And he would always lose, right? Mm-hmm. It's kind of like that guy who said every time I take a long position, it goes short. And he wouldn't get out, and he'd suffer losses. And he created a plan at one point in his career. And he started to really look hard at because he went up to see somebody else, one of his friends that he hadn't seen in quite a while. And this person lived in Upper Westchester County, which is a very wealthy, affluent area, and had a beautiful house and all of that. And Marty said Marty was still living in a small flat in the east side of New York. And he said, how did you do this? And he said, well, I created a plan, and I just stuck to it. And for that, you know, Marty it kind of hit him by the side of the head and said, that's what I got to do. And he went home and stayed up all night and into the next day, wrote his plan, and in the process realized that when he was wrong, he'd do his analysis, and he gets in the trade, but when it goes against him, he gets the hell out, as he would say. Why? Because I want to be able to trade again the next day. If the market's proving me wrong, I'll accept that. I don't have to be right any longer. And he said, that's what made the difference for me. And when I read that, it was like, you know, the scales fell off the eyelids. I realized that's what I was doing too.
Yep, and you're right. It's human nature. You know, it's totally human nature. You want to always be right about everything, and it's quite difficult sometimes, especially when you're educating people, and you're showing a trade, and suddenly the trade doesn't work. They go, oh, that doesn't work. But you know that we know that the odds, we put the odds in our favour where we can, and when the setup works, it makes a lot of money. If it doesn't, you close it. That's trading, everyone. That is what it's all about. Well, and Lance just said, and I'm pleased because Lance is in here. He says, I think I've cracked it now. Thanks, everyone. I mean, and that's great, Lance, because it is about that. Everyone in business, if you're a business owner and Lance owns a business, You have to be right about your business, don't you? You can't make mistakes. You've got to be right. We all make mistakes. In trading, everyone wants to make money and be right all the time. But you've got to accept that that is part of the business of trading. You're not going to be right all the time. But if you're right most of the time, you're going to have a nice profit at the end of the month. Definitely. All right, Gary, I'll hand over to you. And please do continue because we've got lots of favourable comments coming in. So over to you.
Okay. I'll go off on a tangent since that's my want, I guess, in life. Let me just talk a little bit about this. I said before earlier that I was in a trade in Australia, and people said, oh, you should take it off, you're in profit. And I didn't. It happened a couple of times, and I didn't. And they said, well, why not? And I said, because I'm following a process of trading. This is my process. And they said, well, what if it doesn't work out? And I said, well, most of the time it does work out, but sometimes it doesn't. And if it doesn't work out, then that's okay. I'm following my process because, the vast majority of the times it will work out. So you can think of it like this. You can have an outcome, the trade result, right? It can either be a positive, meaning you have a winning trade, or it can be what we would call a negative outcome or a losing trade. Okay, you can have a loss. It's a very simple way to think about this, but it's a very useful way to do so. Now, you can also have, and we have a process. You have a good process that's well defined and you follow that process, or you can also have a bad process, right? Just kind of jumping in and out of the market any old time. Whatever looks attractive to you, any pretty price bar will get your attention, okay? Well, when we follow a process and we have a win, that's expected, right? That's expected. We expect this to happen. Why? Because we have an edge. Maybe we have, a winning percentage of 70% winners and 30% losers, right? And that's our probability. And that's an edge because more than 7 times out of 10, we're going to have a winning trade. So over 500 trades, 350 are going to be winners, but 150 are going to be losers. And the thing is, we never know when it's going to be one of these 30% losing trades, right? So we see the setup, we take it, and if it turns into a loss, then okay, it does. It's the probabilities of the game. So if we have a loss, we just hit the wrong probability, and it's bad luck. Too bad for us, right? Not much we could do about it. The trade setup was good, and so on. It's just bad luck. Well, we can also have a bad process and get and have a loss, right? We jump into a price bar that's starting to take off, and we say, oh, we want to get in that trade, and we have a loss, and that's not a good thing, right? We can also get into a trade and not have a good process. And that we would call, and it's a winner, because I can put a trade on I can do it randomly, and I can have a winner, right? And that's just dumb luck, if you think about it. That's just dumb luck. I trade randomly, and every once in a while the squirrel finds the nut, and that's, a winning trade, but that's just dumb luck. It's not following any kind of system or any kind of process. And when I have a loss, and I'm following a bad process, I'm jumping into, a cute price bar that doesn't have any background or structure or anything else to it, that's justice. In fact, that's poetic justice. You should lose on that. You should have a loss, okay, if you think about it. So just a little idea here about process, following a process. VSA is a terrific process. The Wyckoff method is a terrific process. There are many out there. And it doesn't, probably in the end, it doesn't probably matter too much which process you follow, as long as you have a good, solid process. If you're not doing that, you're trading randomly. And anytime you have a winning trade, it's dumb luck. And most of the time you're going to have a loss, and that should be, because you haven't developed the skills yet. You're not following a process, and you haven't developed the skills. And you will never be a winner in that case. All right, enough of the high horse there, okay? Or that little, okay, from the current slide. Okay, let's take a look at a market here. This is a daily chart of a market. What do you see at bar 1? We're going to go through this bar by bar here. What do you see on bar 1 here? A gotcha bar, okay. Ultra high volume, right. High volume closing on the low. What about the spread of this bar? Is it wide or is it small? It's wide, right? Wide spread, huge spread. Do we see any other high volume down bars with such a wide spread since this uptrend began? No, right? No, it's not climactic action here, Bill. It's not climactic action. This is what I would call a change of behavior. Something I always look for. When a trend is mature like this, in other words, when it's gone on for a while, and suddenly, out of the blue, almost, out of nowhere, in other words, we get this large bar in terms of the spread. And you remember, the spread's the difference between the high and the low of the range, right? When we see that bigger than any other down bar in an uptrend, since that uptrend began, and the volume is higher to the downside than any downside bar that we see in this uptrend. And you can see, here's the biggest other downside bar, right? And that's this volume. Well, this volume dwarfs that, okay? And this spread is definitely larger. And you can just see, you just eyeball this. There's a down bar here, not much volume. Kind of a down bar here, a little more volume maybe. Down bar here, not much, not much. This is definitely the biggest. This is a change in behavior. It's saying that selling has come into the market, and we want to be aware of that, okay? Everybody see that. How do I reconcile this with smart money buying on down bars? They would be buying on down bars at the bottom end of a trend, Michael, not at the top here, okay? They're not going to be buying big time in a very mature trend like this. They're going to be buying where it's advantageous. Look. It's a transfer. You know, Tom makes this point really, really well in his book, The Undeclared Secrets. He says that there's this constant transfer of stock between the average people, what he calls the herd, the average traders, you know, all of us, right, versus the smart money, the professional traders. There's a transfer of stock going on, or contracts, take your pick. And it's a transfer when the smart money recognize that price is low, and they can see an opportunity to make money by acquiring or accumulating that stock, they're going to buy. But they're not going to be buying way up high. They're going to be buying when the price is down low. And when the price rallies, that's when the herd starts to say, oh, wow, the price is, you know, I could have got in here, I could have got in here, I could have got in here. And now the price is way up here. It's going to go to the moon. It's going to go rocketing off. I want to get in. That's the herd mentality. And they're eager to buy at that point because they've been watching price going up. The professional is totally different. They bought down in here in this little accumulation zone, And now they're looking to sell out at higher prices. So we're not going to see that kind of high volume come in to the downside and price be accumulated when we are in a mature trend. It's also, think about it this way, it's a transfer of risk. Here, in this level, the risk was low to own stock, right? Because price was depressed down here. In fact, it's risky not to own stock. At this point, when we're substantially higher, it's risky to continue to hold it. So it's not just a transfer of stock, it's also a transfer of risk as well. Okay? Think about it that way. Hopefully that'll help. Okay, so for the first time we see big volume coming into the downside. That's supply coming in a mature trend. What do we see on the rally up here to 3? Well, you all ought to know this. There's a no demand up there. Not a picture perfect no demand because it's closing on its high. We'd want to see it closing in the middle a little bit. But it's still no demand nevertheless, meaning that the professional side of the market is not willing to follow price up higher. Okay? Look at what happens now on bar 4. It rallies up above the high of 3, comes right up to the high of 1, and what do we see? A pickup in volume, and it closes underneath the high of 3. Negativity, right? Negativity. Okay, everybody see that? You following this so far? Let me see some wiser yeses. Okay, good, good. It's important that you do. So, do we short in here? No, but I'm noticing this, because why wouldn't I short here? Because this is a big mature trend, and if we're going to get a decent move out of this, which bar number 1 suggests we will, there has to be a time, just like here, there was quite a few, this is a daily chart, so just kind of mark this off. There's 1, 2, 3, 4, almost 5 weeks of accumulation here. So are they going to just distribute all in a week and then the market's going to fall? No, probably not, right? They need time to do that. Okay? Would bar 1 still be considered ultra-high volume with a wide spread? Yeah, it's ultra-high volume, wide spread to the downside, closing near its lows. Okay? So, let's take a look here. So we ended at 4 on the previous chart. What happens at 5? Well, we dip underneath the lows of 4 and 3, right? We don't go any lower. This would be an intraday spring, in fact, maybe on a 30-minute chart, or as I said, this is a daily, maybe a 15-minute chart that we've been looking at on the S&Ps, okay? And we get some volume come in on that, and we rally up. But immediately what happens? We go up above this level here, the last swing high before bar number 1. And what do we see here on bar 7? We see low demand, low volume, and an upthrust. Okay? Yeah, good, Joyce, good. While we were watching this, my mentor, David Weiss, took a trade here. He shorted this right here. Okay? He made that as a short play. Let's go a little further in this. What do I mean by swing high? Well, just that there's a little pullback here. So this is a swing down. This is the last swing high. Okay? We rally up. So, and fail to follow through and go higher. What do you notice about bar 8? Samir asks, for ease of movement and volume, do you look at daily or weekly chart? I look at both, Samir. I look at both. So what do we see at bar 8? Wide range finishing on low. What about the volume? Ultra high, right? Yeah. It's the same level as bar number 1. when we are in an uptrend like this, and we're in a mature uptrend, there's still going to be a lot of buying going on, isn't there? I remember I told you a little bit earlier that I used to work in the Veterans Administration hospitals when I was a psychologist. And I was first getting into trading at that point. It was the 1999-2000 high. And I remember there was this male nurse, the guy who was a nurse, and I would be in meetings with him. And he knew I was interested in this thing called trading. It's when I first started to trade in 1999. And I remember the market was going up and up and up, and all the dot-com, remember the new economy? There's the U.S. Open. Remember the new economy? There's no need for earnings or profits. The dot-com boom was in full force, and, you know, it's a new economy, stupid. What do you mean, earnings? That has nothing to do with anything. So the market had traveled quite a ways, and I remember this nurse saying, I'm buying more Microsoft on any dip down because each time it dips down, I'm getting more stock because Microsoft is going to put my kids through college. And that was the thinking then. And every taxi driver in New York City had a laptop, and they were buying, you know, in between. Sometimes you couldn't even get a cab because they were day trading the damn stock market. So notice what happens here. On bar 8, we come down, widespread down. Is it easier now to move, looking at this, and then looking at the move up to A? Notice how volume's falling off again. Is it easier to move the market up, or is it easier to move the market down? So far here, comparing 1 and 8, it's easy to go down. Struggling going up has appeared. So we have a change of behavior. We have ease of movement down. And we have struggle going up. There's a story that's being created here. There's a story of supply overcoming demand, okay, in this market. And as the market tries to rally up, we see volume drying up on saying that demand is just not following this market up. Let's go a little further in this. So on A, we see, boy, it looks like, you know, to the unskilled reader, A looks like it wants to go up higher. It's closing firm. It's a higher low, a higher high. But it gets to the top of bar 8 and bar 1, and it fails to follow through to the upside. And what happens at B? More volume comes in, still ultra high volume here, or very high volume, ease of movement going down. Okay? No demand, that's right. So do you see the story here? Do you see, do you see the story here of supply overcoming demand? Good, Michael. I'm glad this is helpful. Good, good. Yeah, distribution. Lance says, distribution. Exactly, distribution. And right here at C, this is where I went short. Actually, I went short on the bottom of C. This I saw as an inside bar. And I'm looking at this, and I'm going back in here, and I'm saying we've been inside bar 8 for 1, 2, 3, 4, almost a whole week. So I'm seeing supply in here. If this breaks, because now the market's coiled up, right? The market, if we were to think about, you know, just a little bit of how it's coiling in here, and it's now dead center in the middle of this trading range in here. It's dead center in the middle of the trading range. And there's a lot of evidence that there's distribution that's taken place. This is what Wyckoff called being on the springboard. Okay, being on, it's different than a spring. It's being on the springboard. In other words, like a diving board. And it's ready to dive into the pool. Okay? So a simple way to trade this, you could go short on the close, but I just put a sell stop order in on the low here. And let's see what happens. We start coming down at D. I see nice volume coming in at D. That looks cool. I'm happy. We've broken the lows of 1 and 8 here. The next bar, strong volume still, no ability to rally. And then look at F. What happened here at F? What happened at F? Do I know why David Weiss took the up thrust at 7? Yeah, because it was an up thrust. He saw no demand up here. He saw all of this going on in this struggle to go up. So he was short all the way through this. But he's a brilliant trader. Capitulation. Yeah, that's a gotcha bar. This is, anybody know what this is? If I say this is May 6, 2010. The flash crash. Yes, exactly. The flash crash. Isn't that interesting? Now, I'm not trying to say that we could predict the flash crash. I'm not saying that at all. What I'm saying is that there was plenty of evidence in here for the market to go down. And this was a gift that it went like this. Now, let me say another thing, too, that this is easy to do in hindsight, right? Everybody says, oh, this is so cool. But it's not the live edge of the chart. And that's right. It's not the live edge of the chart. And when you're looking at the live edge of the chart, suddenly all the psychology starts to come into play. And I've got to be right, and I can't have a loss, and so on and so forth. Well, it takes time to build these skills. As I said, you're not going to just be able to hear a webinar like this one time and then be able to do this. You've got to work through charts. I'm going to give you some ideas on this in a bit. But let me also say this. This was also very significant in my developing my skills in trading, because I felt like, son of a gun, you could see it in hindsight, but I can't see it live on the live edge of the market, of the live edge of the chart. How, it's really impossible. And then I read that Tom said this, that yes, it is difficult to see, and it requires, not that it's difficult to see, but it just requires building the skills for it. And he said it's all there in the charts on the live edge of the market. It's all there for you to see. It's really developing the skill set to be able to see it. Okay? So yeah, it's easy in hindsight. There's no question about it that it's much more difficult. But it is all there. It is all there. And you can see that it was all. And this is sort of a dramatic example, but I wanted to pick that out for you to show that it is all there on the live edge of the chart. Now, let's take a look up here. We get bigger volume than we've seen so far. We said, boy, this was bar 1 right here, and this was bar 8, right? We said these are big volumes, right? Look at the volume that comes in here, and then it closes. So we are anticipating some sort of stopping volume in here, and we want to see this start to rally up. But what happens when we get up to K? What happens when we get up to K? What happens? What do you notice in terms of the spreads, the closes, the volumes? No demand again, yeah. And at resistance, says David, and that's exactly right. If we think about this 1 and 8 as being significant, there was support. There's a lot of volume that came in, and there was support that came in, right, in these two levels. But then we broke down through it, and here we are revisiting it again on no demand. Remember, Tom said that when a market is pushing down through support, it's going to push down through on wider spread and increased volume, and it's going to the odds are favorable to break that support. Well, this is just the opposite. When it's pushing up and trying to go up on light volume, it's very, very unlikely that it's going to drive through that support. So here is the picture-perfect short opportunity right here. And you can see that it drives on down. Okay? Now, the market went sideways for a little bit longer and then rallied up from here. But look at the volume. I kind of boxed this out, but really it should be boxed out like this. Look at the high volume in here. Compare that with all of this. Look at the high volume that occurred here in this level. Compare that with this volume. And then you can see on the downside, we start to pick up high volume in the accumulation zones, in the accumulation zone in here. So what I said before, being able to look in terms of blocks of volume is really important to be able to do because it does indicate the professional activity is involved at those points where it's no longer risky or too risky to hold stock. And they see value and they're buying in here in this area and they're selling out in here in this area and buying in here in this area. Okay? All right. Was that ICE at K? Yes, it was. We're going to talk about ICE and jumping across the creek and all that stuff. And I'm going to, Gavin, how long do we want to end this around 10 o'clock your time? I have no idea what time that is for me. And as Gavin's coming in, let me just give you a couple of comments here. This does take a lot of practice, but it's really well worth it. Get some data. Here's how you can practice. If you're a swing trader, get weekly and daily charts over the past 10 years. If you're a day trader, get daily 30-minute and maybe 5-minute charts over the past year. Apply VSA. If you've got Trade Guider, you've got a big advantage because you're going to see all these indications of strength and weakness. And Trade Guider would pick all of this stuff up. I learned it before I learned this method before I ran into Tom and his work. And so, you know, it almost is second nature. Well, not quite second nature, but it's you know, I've developed the skill set in there. But the Trade Guider software originally was created to teach people for educational purposes in those dialog boxes. Use them. They're terrific. They're really terrific. Look, when you're looking at your data set, tops, bottoms, and the continuation of trends. Figure out what's going on there. And pay attention to higher time period support and resistance. And some people say, do I teach? What I do, but I don't have time to do one-on-one now. I'm writing a book, as Gavin said. I'm doing this for a while, so I don't really have time. But on Thursday nights, I do something called Deep Practice. And it's every night. It's tonight, in fact. We meet every Thursday night. And what I do is I go through bar by bar, and I teach people how to do exactly what we're doing here. And we do it, you know, a bar or a few bars at a time, and we kind of frame out. We're looking at a day trading chart. We frame out what our game plan will be for tomorrow. If we're looking at a swing chart, we'll frame out what our game plan is for the next week or two, what we want to see in order to buy or sell, depending on how we analyze the market. And then we go in and do bar by bar with that. All right, so those are a couple of ideas. Okay, Gavin's off for a bit. It's 11 o'clock for me. Okay, perfect. So that gives me a chance. Any questions or comments on this? What stops do I use for daily market or steps do I use for daily market evaluation? Well, I kind of went through it. I'm looking at trends. I draw a lot of lines in. I look at individual price bars. I look at the higher time frame, what's going on there. Maybe I'll go up a couple of time frames to see what's happening. And then
Gary, just so you know, we're listening intently, but we're watching our trade.
I know. I can see that trade.
We're not stopped out yet until we've managed.
No, I can see it, and I can see the weakness coming in here on the S&Ps. I can pull up my chart. I'd like to be in the trade too, but I'm not. But you can see that we're starting to see, we talked a little bit earlier about the weakness coming in now. For the first time, we're seeing volume coming in on the swing down or the wave down. This is David Weiss's wave chart.
That's what I'm using. That's what I'm using, the Weiss wave, to manage this through. And we took 300 profit already, and we're now back in.
Yeah.
And we're looking for about a 1400 S&P target for the day. So.
Mm-hmm. It's holding in here. I'd like to see a little no demand up in this area on this time frame. But you can see that on the little bit higher time frame, we pushed up above yesterday's high and that swing high from 2 days ago, and we're finding resistance in here. This is an up thrust in here in Wyckoff terms. We see shortening of the thrust, trying to push that market up, but it's having difficulty going up. Don't see a lot of volume coming in. Some volume. I would anticipate this just to roll over and come off.
Yeah. And by the way, Gary, just so you know, I don't know if you can see all the comments, but everyone's saying absolutely brilliant. Superb. Okay, let's have a look. How do you identify when you are wrong and close out the position? Good question.
Good question. Good question. Sometimes I use, if it doesn't, like for example, if, in here, if I shorted this and I started to see this kind of movement, let me get a better. If I shorted in here and I saw that the market's holding in here and starting to push up, I'm out of that trade. And I don't care if it's, a point or two loss or what have you, I'm out. I'm not going to hold until it ticks me out. It ticks me out up here. Just not going to do it. Here, the short would be as it comes back down through this high here. So what I would do is, if I were following this and not talking, I'd be looking at this. So I'm short on this bar right here because I see the background conditions very nicely. So I'm short on this bar. My stop is here. I got a nice tight stop, and it's still there. I want to see it take these lows out before I move that stop. Okay, I'm in close to the danger point, and I don't need to if I get stopped out, what am I going to lose? 1.5, 2 points in here, big deal. But I have a chance to see this go down further down here, so that's what I'm going to do. This won't draw when the market's live because the price is continuing to change here.
Yeah, Gary, when's your book coming out? We've been asked. You're writing a book, obviously.
That's what my publisher keeps asking too.
Well, you've got several people in the room asking, so.
Yeah, probably about this time next year.
My wife said to me, Gavin, your book's due to be published on December the 21st, 2012. It's my third book. And I was like, well, guess what, honey? I've prepared it all. I just haven't started to write it yet. But actually, I have, actually. So, and I know you have. And David's book is due out soon as well, isn't it? David Weister's book.
David's book is due out, yeah. He's still not finished with it, as far as I know. But, mine's going to be on trading psychology, and his is going to be on applying the Wyckoff in the current markets. And he'll talk about the Weiss wave and all of that good stuff. That's definitely a book you want to get. You certainly want to see that. It will be very useful.
Yeah, good. Okay, there's a couple of comments coming in here. TP's asking, where did you get back in on the trade? Okay, I've scaled into the position. Okay, so what we'll show you is, in a minute, we'll show you the setup. At this moment in time, just so you know, the S&P is behaving very unusually. And I want to keep your mic open, Gary, because what we'll do is let's put the chart up. And it is an unusual moment in the S&P because you usually expect something to happen, and here we are. Okay, so this is where we're currently at. I'm going to get Tom to comment. This is I'm going to put the 15-minute chart up of the S&P. So you've got a 15-minute chart that you should. Can everyone see the 15-minute chart? We've got a resistance line. We've got this massive volume here. Okay, and there it is. And by the way, I'm still short. Okay, just so you know, I'm in a trade here, so I'm in a real trade. I'm not in a. But we'll talk about my trade in a minute. I'm more interested in Tom's view. Tom, what's going on here?
Well, you don't often see the S&P 500 behaving this way. I mean, we've seen a nasty-looking up thrust earlier on, which we mentioned, we talked about, it was definitely an artificial markup. The market didn't actually genuinely go up there. It wasn't a genuine move, because I was sitting here watching it. I saw the screen. It flashed like a rocket in the air overhead. It went bang and then came straight down in less than a second. So that was obviously a trick by the market makers, right, to catch stops. And normally they would only do that in a weak market. On that, the market then went up a few bars and had another upthrust at the opening of the S&P 500. The volume, of course, is massive because it's genuine volume from the pit. So, and it looks massive because the rest of the volume was Globex. But even that's closing definitely well down, and even that bar looks weak. So you certainly wouldn't want to go long. The market, in theory, should have fallen. And, of course, you've got that distribution here that we discussed about this morning to the left. So the market should be weak.
Yeah, thanks, Tom. And again, it should behave that way, but if it's being manipulated, we never know. What we've got to look for now, everyone, for those of you that are following, this market needs a gotcha bar now. That's what it needs. It needs a push through this line here. Okay, and Gary, would you agree with that? That we need to see this surge in volume come down through that line, and then we're going to have a nice fall. What do you think? No, I don't think it's Gary. You still there? I don't know if he's probably gone to get a cup of tea, and I don't blame him. But yeah, what we're looking for is quite simply.
Yeah, I'm back.
Yeah, okay, yeah. Gary, by the way, my brother Darren says hello to you. He's just bought a dog. He's bought a. He's now the proud possessor of a Staffordshire Bull Terrier.
Oh, wow.
But he sends his best regards to you. But I mean, do you agree? I mean, this bar it should be a weak bar, and if that is a weak bar, which I think it is, and obviously I'm short, we should see a push down through a 14.1150. That's my key line right there. That's what I call my trigger number. And by the way, I'm trading 3 accounts here. I'm not trading 1 account. So I could be adding into the position here on this trade down. What's your thoughts?
Oh, I mean, there's so much weakness there. It's, I cannot see that market rally. I'd be very surprised if it does rally up. Of course it can, but, the odds just favor the downside. So, and look, if it comes down, here's another thought too. If it comes down, it's going to break these lows here where you've got your 14.11.5 level. If it comes down, it should do that, and then it'll come back up, and we'll have a chance to short it again when it goes.
Oh yeah. And by the way, for those of you that said, where did I go short? I went short before the news with a wide stop, and I did that based on the hedge fund software that we're using. And the reason is I know they're going to mark the price up to these levels. If they're bearish on the market, they want to buy lower, they'll use these type of bars. It's classic. They mark it up to catch all the stops, and then they mark it down. And once you learn this, now the key to this trade setup is this closing price here. It needs to penetrate that. It needs to get down to about 14.11 and break that red line. And my goodness, then it's going to then this market will fall. But it hasn't done it yet. You see, you've got to watch it. Everything happens when we're doing these mentorship courses. We're doing them live. We're not doing them in hindsight. Okay, so this whole week with Tom and now bringing in Dr. Gary, yeah, we use PowerPoint slides, sure, but really the best way to learn to read a chart is to watch it as it's happening. Now, if you look at everything on this chart, there's weakness there, but we've always got to look at the behavior. Does the market change behavior because of this bar? If it does, hey, happy days, money's to be made. If it doesn't, then I'm going to manage my trade. And Gary, is that how you manage your positions? You watch the behavior of the market. I'm seeing what I expect it to do, but that doesn't necessarily mean, I'm $125 up. Okay, and if it does change behavior, and it goes down to 1,400, I'll make $1,000 on a $5,000 account. If it doesn't, my risk up here is managed because I'm managing the trade. I'm in a real trade. Okay? If it doesn't do what I expect it to do, I'm going to change my opinion. And that's what you all need to learn. Right, Gary?
Absolutely. Absolutely. You've got to be, what I say, you have to be psychologically flexible and not get locked into a bias. We certainly come in with a bias. We come in with a game plan every day. If you're trading, the S&Ps or the Aussie dollar or the British pound or gold or oil, whatever it is you're trading, you want to come in with a game plan, what you think it's going to do. Now, sometimes that game plan doesn't work out, but that's valuable too. That's valuable information. If you're thinking that, the market is going to be a short and it turns out that it doesn't, it goes through that level, then it's telling you that, okay, something you missed in your analysis, better go back and take a look. And that's very useful information. That's very useful information. But
a quick question came in here, Gary. Good one. When you were managing your trade in Australia and you had $300 on the board, I remember that Greg, and I think Fiona's in here, Greg, who's Fiona's boyfriend, was like, we'll just take your profit. You've got 300 on the board. Take the profit.
Right.
Okay? And you said, no, I don't see a reason to just take profit here. I'm going to let this run. Can you explain your thought process?
Yeah, I try to let the market, as best I can, I try to let the market tell me when to enter and when to exit. And at the time that, I think it was Greg, he said that it was $3,000 or $3,500 worth of profit. He said, gee, you got $3,500 of profit in there. Why don't you just take it and get out? And the reason is because I saw no countervening signals for me to exit. Everything continued to look bullish. There was no reason to get out of the trade. And it was a good, at the time it was a good trade. And I thought it had legs to go further than it did. It did go up to almost $6,000, and then I could see that there was problems with staying long, and we exited. And it turned out to be the right time to exit. The other thing is
actually, hold up, Gary, I've been corrected by Fiona. It was $3,000 on the board at the time, actually, not 300. So sorry, Fiona. Yes, but let's be correct on that one.
Yep. Yeah, that's right. And so, there was no reason to exit, and why take the trade off? I brought my stop up at that point, I think, to maybe $1,000 or $1,500. So win, lose, or draw, if it came back against me, I still had profit. I still had money in the bank. It wasn't like I was in a bad trade where I was going to, be risking $3,000. It was, there was profit there. So no reason to take it off.
Yeah, okay, another question comes in. Gary, can you explain what happened to Google the other day? What do you think of the Google chart? Was it manipulated? Great.
Oh, I haven't looked at Google lately. I'd have to take a look at the chart. You could put it up if you want.
Yeah, the news. Yeah, the new. Well, I'm just watching this market right now, seeing if it's coming down to this level, and it's got to break it before I can manage this position through. Remember now here we're live. Okay, so this is live trading. There is a definite sign of weakness here and here, but we've got to see what David Weiss calls the change in behavior of the market. Now, are we at a resistance level? Do you all agree that this level, my red line, is resistance to price? Yes or no? Do you agree with that statement? Sorry, I'm being a bit of a policeman here, but do you agree that there is definitely resistance to upper movement? Okay, and everyone said yes, there is. But do you agree we're in an uptrend? Do you agree with that statement? We're definitely trending up. Yeah, okay. So now you see the difficulty that traders have. It's going up, but it's having a difficult effort to get through that resistance line. Doesn't mean it won't, but if it does fail, it's going to fail miserably, and I'm going to make a lot of money. If it goes up, I know what my risk is. So Gary, can you just talk a little bit about risk reward? I mean, here we're trading, and again, this is one of Tom's trades. This particular setup, we're trading against the trend, but actually we're trading on the basis that we think the market will fall, but it might not. What is the basis of risk reward? How do you look at these things?
Well, you know, typically traders will say you've got to have, you know, $3 of reward for every dollar of risk that you have. You can think about it that way. It's okay to do, but I don't quite think about it that way. When I look at a trade setup like this, for example, where we have weakness in the background and clear weakness, and as we said, I think this is going to break this here, these lows. We've got clear weakness in upthrusts and supply coming in and so on and so forth. But we're still in an uptrend. So the odds favor that the trend will continue, but if we see weakness here, we want to try to buy into that weakness, in other words, sell the market short, fairly close to the danger point if we can do that. But if we're still in an uptrend, it's a higher risk trade than if we saw that change of behavior and we start to see trending conditions to the downside, right? So the way I would manage that risk is not put on, let's say my normal amount of contracts is 5. So I might not put 5 contracts on here. I might only put 2 or 3 on, okay? And now we're starting to break down as we anticipated we would. So I might only put on 2 contracts. I'm managing my risk better, okay? Or I'm managing my risk that way because I would consider this more of an aggressive trade perhaps than one that is clearly trending and we get a weak pullback in a downtrend, a weak rally in a downtrend. Well, maybe I'll put on 2 units. Maybe I'll put 10 contracts on that instead of 5 because we have such wind in our sails to the downside, okay? I don't really think in terms of, in day trading, I don't really think in terms of, you know, a 3-to-1 risk, reward to risk ratio. What I think about is where am I in the structure of the chart, and is it a risky trade to take or an aggressive trade to take? Is there enough indication there that I've got, you know, a story, if you will, a story of supply overcoming demand or vice versa? And if I do, but I'm still at that point in the chart where we could still continue to go up a little bit, then I won't put on a large amount. That's the professional's edge, is knowing when to put on size and when not to put on size. Okay, and this would be an indication. This would be a spot where we wouldn't put on all that much size, at least on a day trading basis. So there we are. That's what I would say about risk.
Yeah, and now I'm ready to get back in on the trade. I'm just taking a bit of profit off there, and on my other account, I've just done quite well as well. Now, why have I taken the trade off here? Because I expect this to pop up a little. Now, it may not. It may push down further, but again, we'll go back to the old story of little and often. We're not trying to guess where this is going right now. I know they've broken this line, and it's very likely to come back up to that line here and give me some more profit. So here, what I've done is I've looked at the market breaking through this line on high volume, and they've done it just after 9 in the morning. Now, 2 things can happen here. This could go down further, and I would say, you know something, I could have got more out of the trade. But very often, they'll pop it back up and catch people. So I take little and often. And Gary, you've seen me trade many times. I mean, I've traded with you and David. Usually, it's $400, $300. In that particular trade, it was $260. What? Let's have a look. In the space, I had to carry the trade, and that's $250. I had to carry some pressure, which many traders don't know how to deal with. They struggle with carrying negative pressure against them, and yet the market, if it's weak, it is weak, and there it was definitely weak. I mean, there was no doubt about it. Even Tom said to me, he said, if you're long here, you're in trouble. I said, well, right. Tom, I'm short. And we took, again, we've taken 3 live trades since we've been in this mentorship course. Tomorrow we'll do more. But to me, the market is like Alibaba, the cave. You know, this is a $5,000 account. Little and often, little and often. Now, I think this will pop now. It'll probably pop up. What's your thoughts about taking little and often from the market?
Yeah, I like that approach too. I tend to try to hold. See, I'd still be short here if I had sold that, looking for a deeper pullback. Sometimes it works out, or sometimes it doesn't work out, but that's okay too. That's part of my process. If I'm in an upthrust like this, and we're in an overall down move on the daily, then I'm looking for a little bit of a bigger play. But little and often is a good thing. The whole idea behind that Alibaba story, which I really like, and if you haven't told this group, you ought to do say the story. The whole idea behind it is not being greedy.
Correct.
You know?
Little and often.
Yeah.
Little and
Just
often.
take a little bit out, and you do it frequently, and not try to take the whole thing, all the gold out of the cave, because the thieves will catch you, and that's how they got.
Well, here's the pop. Look, Gary. Okay, so what we've seen, the widespread down bar, volume increase, but it closed up here. So I expect a pop, because what the smart money want to do is trap anyone who's too close to the market. So I know I could have taken 300, but I took 250. You know, and I'm grateful, totally grateful for that. And that's a thought process that you must, as a trader, observe. Will I get another setup? Absolutely sure. Absolutely, we'll get another setup. Now, Luke has got a comment. It's good to see how you guys go through the same process, including not always being 100% sure. The goal I have is to learn, maybe unreasonable, being able to read the market like an open book with absolute ease. It's all about weighing up the evidence. I love that statement. Both for and against an up move, and the same for a down move, until one side seems more likely than the other, and the potential risks within your rules. Luke, that's a great comment. I like what you said about the evidence. The evidence today, for me, and again, you know, this is a live account. We're not trading on funny money here. You know, I trade real money, so you can see there's the pop-up. Why did I know that was going to happen? I'd be in a losing position now. Here's why. And let's go and look at it. Let's examine the evidence, as you say, because I like that thought process. The evidence comes in different time frames. On the bigger time frames, as you can see from the diamond trending system, we're going up. On the smaller time frames, we're going down. But overall, the 15-minute chart was my guide. Okay. Starting with that. Weakness based on price action. However, look at the trend of price. It's trying to go up. It's trying to push up. But I know the bears there are squashing. They're squashing the market. They're trying to keep it down. So I think to myself, look, we know markets don't like ultra-high volume and up bars. But then we get this bar. Now look at the bar itself. The market opens. The volume is enormous. Effort versus result. The effort is big. It closes on the low, or near the 25% line of the bar, and I'm short, and I take my profit right down here. I nailed it. Now, I think they're going to mark this up again. Why? I go to another time frame. And when we look at the other time frame, what I see on the smaller time frame is a trend cluster appearing. Now, my entry was at 14.1350. Look at the volume on this down bar. Some group or groups have come in and said, we can't have this going lower right at this moment. We're going to buy into the market. I don't need a signal. I don't need a green indicator. I can read the chart just like Gary does. So let me ask you, Gary, a question here. When you're short, now I'm trading the market in a small time frame. So I've been in that trade for 47 minutes exactly. And I've made $250, which I think is quite nice for 47 minutes worth of work. And I try to do that fairly consistently. How do you teach people yourself through the Wyckoff method how to manage their emotions? Because, you know, there's a real trade going on there. It went against me and then came back to me. And I don't really get emotional about it. You know, we've worked together for many years. There's no emotion in my trading. I just do it. How do you train someone to do that, Gary? Over to you.
Well, the first thing to recognize is that you cannot control your emotions. Everybody thinks you can. That's the conventional wisdom, that you have to be like a robot or an automaton and just trade without emotions. I say that's nonsense. That's not possible, at least with our current mental technology. I've never met a person I've been doing psychology for 16 years. I've never met a single person who can truly control their emotions on a consistent basis. It's not possible. So if it's not possible to control your emotions, why even try? That'll make some of you.
Well, now you freaked them all out. But let me bring Lance. Let me bring Lance in, actually, because Lance has been a big contributor to this course, and I'm very grateful to him. He just typed in here, that last trade you took was worth the course fee. Well, thank you, Lance. I'm glad you enjoyed it. But interesting enough, I want to ask Lance a question there, so that I want Lance to understand the principles. So, Lance, I'm going to switch your mic on. Just bear with me. I'm just going back to a secondary computer here. And your mic will be open any second. Okay, Lance, your mic is open. Can you hear me okay?
Certainly can.
Good. Okay, mate.
Entertainment to its best, that.
Well, you know, what is life all about? It's about having some fun, isn't it? But look, let's look at the logic, though, because I know you've been a big contributor to the course, and I'm glad you are, because we need people to ask questions, and we've had a lot of people asking questions. But let's look at a principle on a small time frame that works in a big time frame. Now, you saw there a live trade where I read the market with Tom. I mean, Tom was quite convinced there was too much supply above us, meaning there were more sell orders at that level above us at around 14.16 on the S&P. And he could see that. He kept saying to me, Gavin, there's too much supply, too much supply. He kept saying it to me. I said, Tom, you're trying to influence my trades, and I try now, because I'm experienced enough not to let him influence me. I have to make my own decisions. But then I've got several screens that we're looking at here, and I see a number of things going on in the market. Now, number one, Dr. Gary has already explained the change in behaviour in the market. I think he's done that greatly. But I saw something that we've taught you last week. Now, Lance, what is that there? Can you tell me?
That is a hidden upthrust.
Well done.
At resistance.
You're the man. Superb. Now, I know you've only been doing this for a few weeks, but you're absolutely correct. That is a hidden upthrust at resistance, okay? You've actually nailed it. And here on the other chart here, you've got a signal that tells you there's an upthrust at a previous level. Now, we've done this live in this mentorship course, which makes it far more exciting, in my opinion, than doing it with PowerPoint slides, because you can do anything in hindsight and make it look great. But in order to teach people, the best way is to do it with real money at the right edge. Now, here we have, as you quite rightly identified, an upthrust at resistance. But what do the markets, they're devious, right? Tom always says, just when you think you should be going long and you buy into the market, they do that. The market is marked up absolutely artificially. There it is. Now, that was my entry. Now, why did I decide to short that? Because I can see what's going on. Bull markets do not behave in that manner. They can't. And Gary, you still got your mic open?
I think so, yeah.
Yeah, you have. Gary, and obviously we've got Lance's mic open as well. This is the classic Wyckoff trade that I just took there.
Right.
Can you explain why that is a classic Wyckoff print? Forgetting Tom Williams for a minute, and I mean that with all due respect, because it's his mentorship, of course, and I mean that with all due respect, but just taking out the computerized programming for a minute, why would Wyckoff short that bar? Gary, over to you.
Because what it shows is an inability to follow through to the upside. At that point, the market rallies up above the last high there that was put in, yeah, exactly, at 732 or just a little before that. It rallies up above that, and it goes up on nice volume, right? And it looks like if we were watching that bar, we would initially think, oh, the market's going to push up above that. But then it comes back down and fails to go higher. Well, in fact, it's hard to say this without thinking about Tom, because Tom would say bullish markets don't act like that. When they push through known resistance, they'll continue to drive up because everybody's buying. If they do just the opposite, it must mean that selling is involved in the market. And there's even more volume on that upthrust bar than there is on the bar preceding it, which was bullish, right? It pushes up above the little resistance level there that we see from about 8:15 or so. And there's even more volume. Well, that means that somebody stepped in and refused to allow that market to go higher. And they're doing it at a known resistance point. And that's an upthrust. That's a Wyckoff type upthrust.
It's totally there. And Lance, just so you know, because I know you've been a great contributor, this is what Rita often trades very, very profitably by looking at when even if you're in a bull market on the daily chart, even the weekly chart, you will see these principles very, very often coming in. Now today,
it was brilliant to witness. It was really great to witness, but there was something that I noticed on the higher time frame. I'm just wondering if I can just go to a higher time frame before.
Sure. Which time frame do you want to look at? Which one?
What was it, the 15-minute? If you put the 15 up.
Yep.
Where's the long widespread down bar?
Well, hey, no. Well, Lance, this is the widespread bar. But the reason I exited,
I understand.
Yeah,
I think it was 2 bars back. Now I got this. For some reason, it stayed in my mind. And he was. I don't know whether he's still with Trade Guider. I've not heard from him for a while. It was something I picked up in the archive. Mm-hmm. And actually, it was the bar with the signal on. Actually,
that one there. Yeah.
There's a test bar in the background. Am I allowed to mention this fella's name? I don't know if he's still with Trade Guider.
Yeah, mention anyone you want. I don't care. Yeah, whatever.
Seb Mambi.
Oh, Sebastian. Yeah, I know Seb. Yeah.
Sebastian. There's a test bar in the back. It's coloured in black, so it's a level bar, but it's got a green signal note. Back.
There.
Yeah, that bar there. Now,
the
widespread down bar with the signal on. Basically, I believe, if I interpreted it right, Seb would have said from there he would have been quite adamant, and I liked his style that the market's going to go down because it's gone past this test bar in the background, and that test at that moment had failed as well.
Correct. Yeah, he's absolutely right. He's exactly right. Exactly why I went short. Now, I closed my position out for a reason, and I saw this coming in. Now, what we are seeing right now, prior to the US election, is bulls and bears battling the market, which is why some of you are finding it difficult to trade the principles. Even Tom has been looking at some of these principles going, you know something? We've got bearishness, and then we've got bullishness. I closed my position out. I saw some buying coming in. So bear in mind, a great trader, a professional trader, and Gary, you might want to elaborate, will read the market bar by bar, correct? We're not looking, we're looking at small and big time frames depending on our individual strategy. Gary, go on, Lance. Yeah, sorry, say that again, Lance.
I say, I actually saw the moment you flattened it on your dome, and it was perfect, flawless. From when you got it into when you even exited, flawless, quality.
Yep. Well, and there was a reason, though, and I want everyone to understand the reasoning behind it, because it might be flawless at that point, but certainly I'm not a flawless trader. I do make losing trades, and so does Gary. But in this instant, as we're doing this mentorship course live, we saw evidence, okay, and again, excuse the ex-policeman bit here, but something was going on this bar here, okay. Now, Gary, can you talk about why the markets change behavior in different time frames? Because I think a lot of traders, especially here in this seminar, some of them will be trading weekly charts, daily charts, maybe, I don't know, 4-hour charts, and some others will be trading 1-minute chart, 2-minute chart, 3-minute chart, and they don't get in their heads, they don't understand, and Lance, I'm just going to mute you for a second there, they don't understand the logic of supply and demand, and I want from today's session from them to learn the key about supply and demand. It moves every second. Wyckoff said the market moves second by second, moment by moment. I exited my position right at the bottom of this market and it's gone back up because I can read the bars. So can you explain why is it that supply and demand, as Wyckoff taught it, moves second by second, moment by moment, but week by week? Could you explain that?
Yeah. If you think about it, if you're in a daily downtrend, you certainly can have a screaming uptrend on a 5-minute basis, right? As the daily retraces back up, let's say the daily's been going down for quite a bit, and now it reaches a level where it's a little oversold in the price, and it needs to. The market moves in waves. We know that from Wyckoff. It never goes in a straight line from A to B. It'll go in a zigzag type of line. Well, when it's zigging, it's moving down with ease, and when it's zagging, it's coming back up a little bit to retrace some of that and to consolidate some of the new price levels that new price lows in this example, because we're in a downtrend. Well, as it's pulling back up on a 5-minute chart, you can easily have a rip-roaring trend go on for a day or maybe 2 days, right? It will move with ease on that time frame, but the overall structure, the overall background of the market on the daily chart is down. And so that's why we want to be able to coordinate different time frames and be able to see from a higher time period the smaller time periods in that chart. In other words, when I showed you that, I think we were working off of a daily chart, or maybe it was a weekly chart, and I drew, we were in an up move, and I drew a downtrend channel and said, well, on the smaller time frame, it's oversold here. Well, if we're oversold on a small time frame and we're in an uptrend on a higher time frame, don't you think that would be a good spot to buy, that oversold level on the smaller time frame? I do, and that's why things will move. You'll see supply come in on the smaller time frame and get oversold, but on the higher time frame we have demand in control, and it's at that point where we see the weakness burn itself out on the smaller time frame that it's a good spot to buy in the higher time frame. It's sort of simple as that.
Yeah, Gary, great explanation. We always look for evidence of when the market's being sold and when it's being bought. And we're not too worried about the signals. I mean, yes, they're there, and that's how I learned how to read bars. I used Tom's knowledge that is built into the software, and after a couple of years of doing it, I can now read these bars without the signals. I don't need the signals because I know them, and that's what this whole mentorship course is all about. Some questions for you as well, Gary, and also for me. Could we talk, Graham asked, about leverage? and what's good and bad about it. Okay, that's an interesting comment. What is leverage? Well, Gary, can you explain to the mentorship course what leverage is when it comes to trading the markets, and why it can be a great thing when you're making money, but can be a killer if you make bad decisions? Gary, over to you.
Yeah, well, leverage. Leverage is about contract size, or the number of shares that you put on if you're trading stocks. But let's just use contracts because it's easier to think in those terms. If you're trading the S&Ps, one contract is equivalent to $50 each point, okay? So you can put one contract on, and if the market moves 5 points, it's going to yield $250, either profit or loss, depending on which way you went into the market. If you put 4 contracts on, now you're no longer trading $50 a point, but now you're trading $200 a point. So if it moves 5 points, it's now $1,000, either up or down in your account. When we think about leverage, we have to think about the account size that we're working with. And you don't really want to put trades on that are going to go over 2% of your account size. And truthfully, I like to keep it about 1.5%, under 2% if I can, but 2% of your account size. So, for example, if you're trading a $10,000 account, to keep it simple, and 2% is $200, right? So you can afford to put one contract on in the S&Ps and put a 4-point stop on, all right? Or if you were going to use 1.5% leverage, you put a 3-point stop in. And that would be your standard unit sized. Leverage, if you put 5 contracts on and you got stopped out at 4 points, you lose $1,000. Now you're down 10% in your account. Do that a few times and you're quickly out of the game. Managing leverage allows you to... Gavin, you want me to really do something on this? Probably take about 5 minutes to go through, but it might be beneficial for people. I just need to pull something up here.
Yeah, take the chart, Gary. That'd be good. Yeah,
right.
let me give you the chart.
I'll spend a little time on this. Let me look for.
Okay.
Let me look for something. That's my dog Asta, by the way. He tells me when to go long or short. Let me just find in my files here. I'll take a moment to pull up. Okay, come on, personal charting. There we go. Nope, that's not it. Hang on, just bear with me just a second. Here we go. Personal trade.
Now, what's your dog's name? Because I'm sure he can help me trade.
This is Asta. Oh yeah, he can certainly help you trade.
Yeah. Now, someone's asking, do you follow moving averages? Is that what you use?
Oh, I have them on my chart. They're helpful.
Yeah. Yeah, I think they are. Let's go back and look and see if we've got another trade set up though on this S&P chart right now, because it's come back down, and I actually missed a trade here. I definitely missed one because we're talking. But yeah, there was someone just typed in hidden ups for us. Yeah, you're very observant, and yeah, we did miss that a little bit. But hey, look, we're trying to teach you stuff, and
it's very hard to multitask.
It's really, I'm very bad at it.
Look, let me show you something very quickly. Forget about the market for a moment. Let's just take a look at this.
Actually, Gary, can you take over for 10 minutes? I'm going to contact Infinity Futures, and they're going to come in and just show quickly how to take a trade on the dome. So if you can take over for 10 minutes, that'd be great.
Sure, no problem.
Okay, here's Gary.
We're talking about leverage. Here's the way to use leverage. Here's exactly the way to use leverage. this is the S&Ps, okay? And remember, in the S&Ps or ES, 1 point equals $50. Okay, 1 point is $50 US. Okay. What I think about in terms of trading any account, well, let's say we're just using an initial account size of $10,000. What I think about doing is making not $1,000 a week or $10,000 a week or doubling my account tomorrow or any of that foolish stuff. What I think about doing is I set myself a goal. It's kind of like being an athlete. I want to make so many points a week in the S&Ps. Okay? I want to make so many points a week. So, for example, I want to average 10 points a week. That's not very hard to do. If you're following a good process and you develop a rudimentary set of skills on how to read the market through VSA and YCOM. So each week I want to try to turn over about 10 points a week in the S&Ps. So, but I'll give myself a range because I want to be a little flexible. Maybe it's 8 points one week. Maybe I do well and I get 12 points, maybe even a little bit more than that. Some weeks maybe I'm down a little bit below that. But let's say that I'm looking to make that 8 or 10 points a week, okay, in the S&Ps. All right, let's go down here to this chart. Because I have a $10,000 account, I'm going to start with one contract. Now, let me say this. If you are saying, well, I'm going to just go in there and trade 5 contracts, even though I only have a $10,000 account or 10 contracts, you know, then I wouldn't. If I were you, I wouldn't be trading because basically you might as well just burn your money up, give it away to the market. You have got to be disciplined about this. You've got to follow a process. And when I say follow a process, it's not just about finding trade setups and identifying trades and taking trades and managing them. It's also managing your money. There's a process to that as well. So you start off with one contract, and that's $50 a point, as we say. So we'll risk 3 points on that, which means $150. As a percentage of the account, this $10,000 account, that's 1.5%. Okay? If I can make 10 points a week during that week, then I'm going to earn $500. It doesn't sound great for those of you who want to be a billionaire next week, but this is the process of trading. On an annual basis, on 10 points a week, that's going to earn you $25,000. Okay? But we do this for 8 weeks. And just go with me for this for a moment. We do this for 8 weeks, and we develop consistency in getting these 8 to 10 points. And at the end of that period, at the end of that 2-month period, not only will we have developed consistency, but we'll have an account now that's $1,400 instead of $10,000. Okay, $14,000, excuse me, instead of $10,000. Okay, so we're doing 2 things here. We're getting consistent, which is the key in trading. Doesn't mean that everything is going to be a winner, but 70% or so are going to be winners. Maybe it's 65 and 30 are going to be losers. But if we did 70-30, right, and we have, you know, for every trade we make, we've got a good expectancy there. We're going to be a net winner on average. And that's what's going to, if we can be consistent in that, that's what's going to be pulling our account size up. So that now gives us the right, because we've earned, not just in terms of money, but in terms of consistency, we've earned the right to increase our contract size to 2. Now, instead of $50 a point, we're $100 a point. If we risk 3 points on that trade, we're now risking $300. That puts us slightly above 2%, but that's okay in this case. But now our weekly earnings are going to be, we're still managing that risk, right? It's still around 2%. But now our weekly earnings are going to be $1,000, and on an annual basis, we're going to be looking at $50. Well, if we do that for 8 weeks, and we're consistent with that, we've now got 22,000 in our account. We start the third 8-week period, we bump up to 3 contracts. Now we're at 150, 3-point risk. That's 450 a risk. But because we're now up over 20,000, that's only 2% risk. Now if we're continuing to be consistent on this, we're earning 1,500 a week. Now we're up to 75,000, and we increase the position. We increase our account size again. We keep doing that, and within a year, we can be up to 10 contracts, trading $500 a point, still risking that 3 points. Now we're 1,500, but look, because we've earned the right to do this, we've earned the right to increase the leverage, but we've maintained our risk under 2%. Now we're earning $5,000 a week, $250,000 a year, and so on and so on. This is the process of managing leverage to both keep your risk at the right level, develop the skill set of making 8 to 10 points a week consistently, but adding leverage because you've both earned your skills and earned an account that allows you to do that to the point where you're using big leverage or bigger leverage. And you can continue this on. You can be doing 100 contracts. You could be doing 200. You could be doing 1,000 contracts if you want on this kind of a system. But this is the process that will get you to the point where you can make money beyond your wildest dreams of avarice. Okay? Hopefully that's helpful to you in this, but this is the way it's done. It's not jumping in to a market and putting 10 contracts on when you only have a small account and hoping that you're going to do well. You might, as I say, you might as well give your money to the market, because that's what is going to that's what's going to happen for you.
Yeah, it talks about that. It's a bit like the Alibaba effect, isn't it, Gary? You know,
absolutely, absolutely.
It's totally Alibaba, and understanding what the Alibaba effect is. You take what you can when you see a principle, and you move into the market. Okay, so let's wrap up then.
And that's approved by my dog Asta, by the way.
Yeah. I love your dog. Okay, so I'm still short here. I've added another position on, looking for a takeout here of this low. So and there's many reasons for it. But I hope you've enjoyed today's seminar. We have traded. We've made some money. I'm in a position here now. This is a key point in the market now because we've got a test, but we've also got weakness in the background. And the test, if it goes down to 1409, this thing will hit the 1405 level, which is what I personally am looking for. And again, it's little and often. Small account size. Don't be too greedy with the market, and always have stops. So I can move this stop now by grabbing it and reducing my risk, which I've just done here. Now, I'm delighted to tell you we've got a bit of a surprise for you today, because Stevens Hahn, who is a broker with Infinity, is going to come in here and show you how to use this platform that I'm using here, and show you all the tricks of the trade about how to manage your positions here. Now, assuming that I want to just take some profit here, and that's Stevens now, I can just move my stop down here and protect my profit. So let's show you how we do that live. Just bear with me a sec. Yeah, sorry about that, everyone. Yeah, that was Stevens. He's going to come in. He's going to show you how to use the platform. Now, again, I'm not going to be greedy. I'm going to try and take some profit here. So what we do is we move our stop down into a break-even position here. Okay, so now I can let this run, but now I can't lose money on the trade because I'm now at a situation in the trade where I can let this run to my profit target, which I may well do, but if I get stopped out, I'm not going to lose any money. So I'm looking for a breakdown of the low with a target of 14.05, but now I can let that trade run. And but this is real money, Philip. No, this is real money. I'm not trading a simulator. And Stevens, who's my broker, will confirm that in a minute. So here we can see that what I've now done is taken a position in the market in harmony with trend, based on the weakness in the background, as you can see. And I'm now, if I get stopped out, I'm not going to lose any money. Now let me ask Gary. Gary, how important is it, do you think, for a trader to get their stops to break even fairly quickly? What's your thoughts? I think Gary's walking the dog actually, but now.
Oh,
now let me,
sorry, no, I was talking without the mic. It really depends on the trade and the market. Sometimes I like to bring it to break even. I think this is the right move that you're doing, which is to lock in some profit.
Yeah, I'm locking it in now. Yeah, I'm locking some money in now. Because,
and just to manage that as it comes down. It shouldn't rally back up, but if it does, you're out with a small profit, and that's good too.
Yeah, and I mean, I could leave my stop here, but I'm going to chase the market a bit here, because if it does move down, we've got stopping volume coming in. I want to try to take anything I can out the market, and if I get stopped out, I put profit in the bank. That's what it's all about. Okay, put profit in the bank. Don't worry about the fact that, oh well, now I mean, there's stopping volume. I could carry this trade through, but a little bit of profit, and it all adds up. It's little and often, little and often. Okay, so we're at 14.0850. The market is falling, as we can see, and I'm 3 ticks away from the market. Now that's where most people's stops are, but I can't lose money on that unless I don't get filled, which is very, very unusual. Usually you get filled. So I'm short because I'm in harmony with trend. And I'm just doing this to show you how this works. This is not a simulator, no. It's a live trade. It's a live trade. There you go. Another $75. And it's done because we know. Okay. Thanks, Stevens. Now, Stevens Hahn is the guy I work with at Infinity. And he understands this platform, obviously, because he uses it and will give you the charting that I showed you yesterday, the Infinity charts, which are great. Now, again, it's all about reading the market. Okay, and this is a small trade there. I was only in the market for 2 minutes. I wasn't in there long. Didn't need to be. I could see the weakness, and I'm trading the principles. Could I get back in again? Possibly. But for this moment in time, I want to introduce you to Stevens. Now, we are seriously overrunning on time. Let me just ask everyone, are you okay with me overrunning today? Again, we're not keeping to the time. We're overrunning. But you okay? Because I know that some people are very strict on their time. But, you know, for me, teaching and showing these setups is just as important to me. And if we have to overrun, then we have to overrun. Because this is your money. You've spent your money to be in here, and I certainly want you to learn. I think it's very important. So I'm going to make Stevens a presenter. So, Stevens, if you've got a microphone, you should be able to say hello to the group here. There's a large group of us. Stevens, welcome from Chicago. How are you today?
Great. How are you guys doing?
Well, we're making money. You know, it's you know, these markets are moving. We've been short, but there's a lot of interest in the platform. Obviously, I've traded today. We've taken a couple of trades on the platform here. Now, Stephen, obviously you're the guy that I deal with. You're my broker at Infinity. Can you confirm that I'm trading a real account? First of all?
Yes, that is a real account. That is your account number, and you're definitely in live mode.
Good. Okay, because we've taken actually four trades since we've done the mentorship course. Now, just so you know, because I've sort of dropped you in it a bit, but I was going to bring you in tomorrow, but we've got a lot of questions about the platform, about how do you take trades, how do you select the quantity of contracts, what is contract size, all of that information is, people are asking questions. Okay. So perhaps, if you don't mind, you could give us a few minutes of your time to explain how the platform works, how, we make loss and profit, because obviously if it's green, you've made profit. If it's red, you've made a loss. And perhaps just to briefly explain what brackets are, because I've had several emails saying, well, what are all these brackets? We don't understand what they are. So I'm going to hand you the chart, and let me give it to you. And Stevens Hahn, welcome to the seminar, and over to you. Here's Stevens.
Perfect, thank you. Here, let's show my screen. Okay, looks like everybody can see my screen. Can you guys can all hear me okay?
Yeah, you're good.
Okay, perfect. All right, so the first thing that you guys should do, if you guys haven't yet, is go to Infinity Futures, and you can sign up for our practice account, so you can at least get familiar with the system. You can do some practice trades. It's live market data, lasts for 30 days. The charting comes with it, and you can put the trade guider plugin right into there. And here, I'm sending out a link to you all, so you don't have to go and try to type that in. You can click on that link and get squared away. So once you actually have that installed, what you're going to have on your computer is an icon. Looks like a purple 8-ball, but it's actually the infinity symbol. And I'm going to go pull that up. So here, just give me a second. There we are. So you'll receive a window like this. This is the login window. And once you go and register, you're actually going to get a demo username and password and a download link. I'm actually going to log into the Simulated Live. And what you'll see, it'll say for in demo mode, it'll say test copy function 20394. So you'll end up selecting that, and you'll hit the button down below. Yours will say you're accessing demo mode. And what's going to appear, here's the platform here. Here, let's go, and we'll select the contract Gavin was looking at, which is the ES contract. So we'll go down to here, and you'll hit the blue plus sign, which will drop your contract information down below. And to pull up the trading ladder for it, you'll hit this down arrow under the letter D, and this will bring up the actual trading dome that you can place trades off of. So there's so we'll just kind of run through this quickly. Right at the top, if you look on the top left-hand side, you have the high for the day, the low, and the volume that's currently in the markets. And next you have trades, and this will actually show the last 3 trades that you've placed for the day. And last, this is actually the last trades that have physically gone through on the exchange for that specific market. Down below right here you have the net change from previous close, which is self-explanatory. And then here you actually have quick buttons to set your quantity for the number of contracts you want to trade. You'll see that right now it's at 1, 5, 10, 25. Let's just change this up. And you can do this through here. So we'll do 2, 3, 4, 5, and 6. Hit OK, and you'll see this changes. So if we want to quickly change our quantity, we can select 2 contracts. And then you can place orders, either by doing a buy or sell market, or you can actually place it on the ladder, which I'm sure Gavin has shown you as either like a buy stop or a buy limit, or sell stop or sell limit. And by doing that, you just left click.
Yeah, Stevens.
Yes?
Stevens, I haven't shown them anything. All I've done is make money on the ladder. I haven't shown them how to place the orders. I've just really taken the orders. I've shown them nothing. And there's a lot of emails come into us about how do you buy and sell. So perhaps you could show that in a bit of detail, because it's all well and good me taking trades and and showing the trade setups and all of that. But it would be very helpful for you to cover how do you place an order in the market, how do you put a bracket in. I've been using simple brackets. So I've been buying and selling at market. In fact, I've shorted 4 times this week on the Aussie dollar and the S&P. But it would be quite helpful, I think, for you to show them how they do that.
Okay. Sounds good. All right, so as you'll see here, right here, I just placed an order. So again, I went to this, it's a buy order. So I went to the buy column right here. And here, we'll place a, we'll go short. We'll place a short order right here at 1406. And so what I'm going to do, I'm going to left click, and right there I got filled. And you'll see that I actually have the brackets currently checked, the simple brackets, which I'll go through in a second. And with this auto checked right here, it'll automatically place the brackets for you. Here, let's move this down. So, currently we're in the trade. We're short from 1406.75, and you'll see this right here. This will show where your position's at, or whether you're long or short, and this will show your actual position in the market. So we're short again from 1406.75. Next down below, as I mentioned, we had the bracket set, and what a bracket order is, it's also called an OCO order, which is one cancels the other. So once your order's in, you can either hit the send bracket order, or if you have the auto checked, it'll place the orders automatically for you. And what it does, it puts in a profit and a stop loss. Here, let me close out of this. And once one gets filled, it cancels the other. So if we get down to 1405 half, it's going to will be flat, and it'll automatically cancel this order. If we want to go and change this, we can actually go and hit the cancel all, which will remove the brackets for us, but we'll leave our position on. And we can go and adjust this, and we can push this button, the send bracket order, and it'll reposition our brackets for us. And does anybody have any questions so far on using this?
Yeah, Stevens, I do.
Okay.
So let's ask the questions that I think the audience are going to ask. Okay. So at this moment in time, you are looking at a what we call the DOM, the depth of market, of the E-mini S&P contract. Yes. Okay. So let's be clear about that. So we're watching the E-mini S&P, which I've been trading this morning with Dr. Gary. What we see here is a simulator. This is not a live account, by the way, so he's not in a live trade here. This is a simulator. And how do we know that, Stevens? How do we know that you're trading a simulator and not a real account?
Well, two different ways. Right up here, you'll see it says sim.
Yep.
And then the other thing is the background color. Normally, if you're in live mode, it's more like it's this gray color right here,
yep.
Where mine's this light blue color, which identifies the simulation mode.
Okay. Now you're looking at a depth of market of the E-mini S&P contract. So what you're trading is not the cash market. If you use this particular product, you're trading the futures contract. Stevens, can you explain for those that are new here, what is the difference between futures and cash? What is a futures contract?
Well, a futures contract, it's a leverage investment tool. And what it is, it's actually when you're placing an order, you're going into a contract to buy at the specific price that you're entering on the expiration of the contract. But since everything is standardized, all the contracts are the same. An E-mini, or for the E-mini contracts, you can just offset your position by selling out to somebody else. So I might be buying from, if I'm in live mode, I might be buying from a guy that's over somewhere in Singapore, but when I close out, it might be some guy that's over in Texas, which is offsetting my position, if that makes sense.
Yeah. A lot of people are going to have trouble with that thought process, because what we're trying to do, Stevens, here is simplify it. There is a buyer and a seller coming into the exchange, correct? And,
yes.
And that's what. And the other thing is your direct market access. So you guys are not like spot forex guys, where they can move the price against you. You're giving direct market access through the CME group.
Exactly. Everything is on a centralized exchange, which like the E-mini S&P 500 contract, that's through the CME group. And they have a server, it's called the Globex server, and it automatically matches up buyers and sellers. And it's done anonymously, so you don't have to worry about somebody on the other end trying to trying to really go after your specific trade, like you do in Forex when you actually have your broker going against you.
Yeah, and that's important. Now, the other question that we've been asked here from Lars, who's a very good customer trade guider, what account size do you think someone needs to realistically trade the futures market? Now, of course, that's an open-ended question, because I know some customers who trade with a $2,000 account and some who trade with a $1 million account or up. So it's a very difficult question to answer. But anyway, what's your thought process on that?
You know what? Yeah, I agree. Where you can open an account for as little as $2,500, but then over here we've got customers with accounts that have $1 million accounts over here. I definitely would recommend funding somewhere around the range, like I'd say a $10,000 account is a good starting balance. $5,000 account, especially if you're just going to start off with one contract, because you do have to remember that these contracts are leveraged. And what I mean by leveraged is the actual cash value of the contract is 50 times whatever the index is. So what we're controlling as a cash product is, right now the market's at we're in from 1406 3/4. So you have to multiply that by 50, which essentially is about $70,000 that we're controlling.
Yeah, and you just got and the market just stopped you out there. Now, can you explain what a stop loss is? Because you've just seen a stop loss. Your stop got hit. Can you explain how to use a protective stop when you're trading?
Yeah, a protective stop loss. That's going to, I guess you would refer to that as a, something just to, it protects you if you're wrong in a trade. So it's always good to have in there, just in case the market does move against you and actually isn't going your direction. It's good to have well, it really isn't a tangible, but it's an actual order in there versus just having a mental note. Because a lot of people, if they just have a mental note, if it goes here, I'm going to get out. They just keep on waiting. Where if you have an actual stop order and it's going to, once that order gets filled, then you're out of the market and you don't have to worry about. You can move on to the next trade. I guess that's the best way to put it.
Stevens, just so we're clear as well, there is no guarantee from the exchange or from Infinity or anyone that stop loss will get filled, correct? So it's there, it's physical, but sometimes it can be moved through with the market, correct?
Partially, yeah, pretty much. Like the stop loss, what it is, it's an order. Once a stop gets touched, it becomes a market order, so it will get filled right away. But the exchanges have certain limitations. Like, let's say if you're trading during a news announcement and the market gaps up, well, there's a certain level. If it goes above that certain level, and it depends on the specific market. So let's say the market you have a stop loss in right here at, let's say, at 1409. And the market gap's up all the way to 1419. The exchange, depending on the contract, I'm not sure what the specific value is for the E-mini S&P, but at some point they can actually, I guess, reject any stop orders that are in the markets. But for the most part, that's a very rare occasion, and if you do have a stop order and the chances of it getting filled, it's extremely likely.
Yeah, I agree. I mean, I've been trading for 10 years and using this platform. I've never had an issue with that, but it's very important for clarity that you must understand that a stop loss is there to protect you, and most often, I'd say 99.9% it gets filled, but if you get gaps or there's a big news announcement, something, a black, what they call it, a black swan event happens. Like, I'll give you an example. The flash crash in 2010, a lot of people's stops were just moved. They didn't even get stops. Yeah. The market just moved through them and said, "Thanks very much. It's so quick and so rapid. Yeah. We're not going to fill you."
Yeah,
Right, Stevens?
the other thing about a stop too is that it becomes a market order, so it's going to fill you at the next available price. So we might have the stop in right here at 14.09 even.
Yeah.
But there might not be somebody to fill the other side up until 14.10 even. So at 14.10 even, this would end up being where you'd get filled.
Yeah. Yeah, absolutely. Yeah, and that's exactly what happens. Now, Lars is asking, okay, good question. And I don't know how you're going to answer this one, Stevens, because we haven't prepared for this. But with the PFG Best situation, they went bust. What is Infinity's situation right now? I mean, if someone wants to open an account with Infinity, what protection do they have to know that you're a reputable firm? Now, of course, I can answer that because I know Jim Mooney and I know the guys, but of course we've got people here who've got money they want to park somewhere and trade. I can totally understand that question, and through literally being completely upfront with people, what security do they have if they put their money with Infinity?
Well, one of the things that's important is that when you look at what PFG is doing, there is some really bad stuff going on. And since then, the regulations have definitely, they keep on tightening the regulations. And one of the reasons that PFG ended up getting caught, or the owner, Russ Wassendorf, was because the NFA decided that they were going to require all FCMs to.
Can you explain what? Can you explain what an FCM is? That means nothing.
Sorry. It's called It's a futures clearing merchant, and their job is they're the ones that actually hold the customer funds, and they're the ones that are when you're with a broker, the clearing firm actually holds the funds, and they have the connection with the exchange. If that makes sense.
It makes total sense. But let me just sort of reiterate it to the group because I've been with you all week. What happens is this: where I had an account with PFG, and I'm sorry we're overrunning, but I hope you're all learning something here. But my account was disappeared, and the reason it is that the NFA and the regulators were not able to electronically look at the bank accounts of the brokers that were holding my money in that one instance.
Yeah, exactly.
And here's what happened. When they changed the system to be able to allow that to happen, what happened was one broker, which we all know about, and some of you will know about, PFG, where I had an account, when they went to electronically look at the account, realized something was wrong because the owner of that company, Russ Wassendorf, it's public knowledge, was actually fraudulently changing the bank statements as they were posted to him personally. But as soon as the electronic look at the accounts came in, every other broker in America pretty much confided to that and said, yeah, thanks very much, we're fine. And there was one bad apple in the barrel. But and that's pretty much how it played out, right, Stevens?
Yeah, and we've actually been submitting it's on a nightly basis. Our clearing firm goes and submits it electronically goes over to the NFA, where the PFG they've been holding out, just for that specific reason. But yeah, now it's mandated that everyone's has it set up electronically, so the NFA can keep tabulations on what's going on. The other thing that's important, and this kind of comes down with the whole MF Global situation, is that our clearing firm, they don't take customer funds and try to go and trade it and make enormous profits off of customer funds. They keep the customer funds in cash, and then also in short-term U.S.-backed treasuries, which, as you know, right now there's pretty much zero interest rate to be had off of those. So they just want to keep the funds as safe as possible for customers. Our clearing firm understands that's what their job is, to be a clearing firm, and not to be a proprietary trader.
Yeah. A couple of questions came in, and let's just answer them. What happens if you're a foreigner? And what we mean by foreigner, and Lance answers this question. He's one of our customers here. He means that not an American citizen putting money in an American brokerage account. What protection do those people have?
It's the same protection as any U.S. customer. You know, the funds are all held in it's called a customer segregated account, which cannot be touched by creditors or the likes.
Good.
So,
and a final thought: when you're taking a trade, now you've still got your trading dome up there. So just explain, because I think a couple of people aren't quite sure about this. We are looking at the futures contract of the E-mini S&P. What other contracts can people trade with your company?
you know what? There's actually an entire list of different contracts here. Let's. I'm going to pull up. Let's see if you guys can see this. Do you guys see this? Is this too small?
It's too small. Now, here's the easy answer. Could you email that to people if they ask you?
Yeah.
Okay. So
Here.
what's your email address? Because I think the easy answer is to get them to email you and request this, because this is a document that I've got myself, and it's extremely good for knowing what the markets are. And on this mentorship course, we want you to know how you make money in the market. Like, for instance, now, Stevens, could you go to the E-mini S&P contract? And
Yeah.
I just want to show what the tick value is, because I've just made something like $350 on that contract. Okay, so for every tick of price, now, this confuses some, but every time the market ticks, to you trading it, if you're in the market, it has a value of $12 US dollars and 50 cents. Right, Stevens?
Yes.
Yeah. So if you're trading 1 point in the S&P, you're trading 4 ticks of price. So basically, as Gary said, $50 per point. So if you're short, as I was today, I took about 4 points out the market, actually 6 points out the market at $50 a point with one contract. If you have 2 contracts, it's 25. 4 contracts, it's 50, etc., etc. So that document, how do they get that? How do they get that, Stephen? They just email you?
Yeah, I just sent over my email, so feel free to email me, and I'll send this out to whoever needs it. But yeah, you were asking about the different markets available, and you'll see, there's a bunch of different bunch of different indexes, and these are the U.S. indices, and there's the bunch of European indices right here. You've got interest rates such as your bonds. You've got your currency futures, and there's a whole list of different currency futures.
Yep.
You have metals such as gold, silver, copper, platinum.
Yeah.
You've got the meats, which they really don't do too much volume. They move pretty well, but unless you have a decent sized account, I'd kind of stay away from some of those meats. Then you have your grains. You have your softs, which are cotton, cocoa, sugar, coffee. And then you also have your energy futures, such as your crude oil, natural gas, heating oil, etc.
Yep. Stevens, right? Okay, we've got a lot of questions coming in. Here's the scoop, because we're going to wrap this up very shortly. But in this mentorship course with Tom, and I know Tom hasn't featured much today, although he's helped me make some money. What I would like you to learn from this is that there are many markets that you can trade. There's not one. Okay, right, Stevens? I mean, you could trade pork bellies. You could be a specialist in corn. You could be a specialist in lean hogs. So the market is there as a whole, but it has individual parts, correct? So
Exactly. And the way you do it, I think, is really smart, where you don't look at just one market, because there's lots of times where, the E-mini might not be moving. Today it's moving, fantastically, but, a week ago or 2 weeks ago, it could have been like relatively flat, but at the same time, you can have other markets that are moving extremely well. So it's nice to have a few options to look at versus just one market.
Yeah, I agree. And we have a scanner that, as we all know, that does that. So there are questions coming in about, okay, obviously which markets to trade. What is the? I mean, and I've tried to explain to people that when you learn to trade, I learned to trade trading the E-mini S&P, which seems to be the most popular market. That's how I learned my craft. But at the end of the day, it might. Some people will look at a chart of lean hogs and go, that makes complete sense to me. So I would advise you, if you're wanting to take this to the next level, Stevens, speak to you, I think, about the actual platform and which markets, yeah, they call you.
Yeah, feel free to give me a call. We can get you all set up. There's an email that I sent out earlier here, or sorry, the link for the platform. I'll send that out again. We can get you all squared away with that. We can get the Trade Guider plugin all set up for you. I've gone through that. Ken over at Trade Guider, I know he knows how to do that really well too. We're both more than capable to help you out with that.
Yeah, and just so you know, everyone in this room, right, because you've paid to be here, you get the Infinity platform, all this information, and the VSA plugin, no charge. You're not going to have to pay any money for it. They're not going to ask you for a credit card, nothing. At the end of 30 days, though, Stevens, if they want to keep it, what's the deal from your perspective? Because several people have typed in, hey, if I want to keep it after 30 days, what's the story?
Okay, so we can usually go and extend a demo if need be for another week or two. But at that point, we need you to open up a live account. And again, like even if you're still just familiarizing yourself with the system, you're not ready to start placing live trades, I recommend then just opening up with the minimum, which is $2,500. And
okay. I just took the screen because I'm about to take another trade. So.
Yeah. Perfect. So, so you'd open up an account, you'd fund with $2,500, and then you would actually have access to, you can go in the simulated live mode, you can do practice trade, and you've got the live market data still. And, there's no cost for the data feed. And as long as live customers do 10 round turns a month or more, the charting is free. If it's less than that, then there's a cost of $15.95, which is a pretty minimal cost.
Yeah. And so I'm using the platform here again. So anyway, Stevens, thank you so much for coming in and joining us today. We appreciate it greatly. If there's any questions, email. Can you put your email up there, Stevens?
Yes, sir.
That'd be good. And I'm sorry, a lot of people have noticed we've overrun. We were supposed to finish this seminar at 9 o'clock in the morning, and it's 10 past 10. Anyway, Stevens, let me introduce you to Dr. Gary Dayton, who should be with us. Gary, you still with us? Is Gary still there?
Excuse me, I sure am.
Yeah.
Yep, I'm here.
Let me introduce you to Stevens Hahn, who's a great guy, based out of Chicago, works for Infinity. Dr. Gary, meet Stevens.
Hi, Stevens.
Dr. Gary, how are you doing?
Good. How are you?
Very good, very good.
Cold in Chicago today?
No, actually, it's pretty nice here. Yesterday was a high of about 75 degrees Fahrenheit. Today, it's I can't complain, right?
I want to come home then, because my home is now in the New Forest, and it's going to be -4 tomorrow night. So there we go. There we go. All right. Thank you very much indeed, Stevens, for your help today. I really appreciate it. Really appreciate your contribution here. If you've got any questions for Stevens, you can email him, and you've got the details that are put up there in the room. And Dr. Gary, a few final words from you. I mean, we've seen the market behave today in a quite negative manner. We looked, as you know, at the 15-minute chart, and we started off with these, what I can only call trap-up moves or up thrusts. What's your thought now, Dr. Gary, and any final words for the group? I've lost Dr. Gary. Can you all hear me? Just want to make sure you can still hear me. Dr.
I'm sorry,
Gary,
I'm talking without the.
yeah,
I muted myself.
Don't do that. We can't hear you. I got a very clear area of potential no demand. It's come up on the smaller time frame. But no, your words of advice for the rest of the group here, and what would you advise them to do as they move forward?
Yeah, the advice is this, that no different than what I said a little bit earlier. It's easy to see this stuff, in hindsight in the market, on the charts. Harder to do that when it's occurring live. It's like playing music, if you will. You've got to learn how to read music off the song sheet. And it's the same thing here. You need to learn how to read the price volume and price action. And that takes time to do. Worthwhile things don't come overnight. You want to spend a lot of time with your charts. If you're a day trader, annotate them every day. Identify the areas where the market turned and where you might have made trades. See if you can start to identify the principles that occur there. And develop a process for yourself. Have a couple of trade setups that you like. I'm sure Gavin's talked to you about a bunch of them. We've looked at up thrusts today, one of my favorite trade setups. We've looked at springs as well on that IWM chart. Another one of my favorite setups. Just start with a couple of simple things. Trade small. Trade really small if you're just starting out. In fact, I wouldn't even be trading the S&Ps, although it's the most liquid market. I'd probably go to the SPY, the ETF for. It's the same thing as the S&Ps. It's just stock instead of contracts. And think about it this way: one S&P contract is the equivalent to 500 shares of SPY. Okay, SPY. So you can trade like 100 shares, you could trade 50 shares of SPY, and do that until you learn how to do this. In fact, paper trade at first, and I know people are going to say, oh, paper trading is no fun without the money behind it. Well, you're not in it for fun and excitement. You're in it to learn. And if you can't, I always say, if you can't sim trade or paper trade, then without your mind telling you something different, that it's more fun or more exciting or more real to do it with money, then you're going to be listening to your mind all the time when it's wrong footing you in the market, and you don't want to be trading that way. Anyway, trade small, go cautiously, spend time in the VSA Club. It's a terrific place to learn. Check my blog out at tradingpsychologyedge.com. I post stuff up there. Usually at least once a week, and frequently more often than not, although less now because I'm working on this book. And just take your time to learn this. And if you do that, as Tom says, you'll have information that very few people in the world really understand. And you'll have it for life, and you'll be able to make money off of it. And that's my parting words for you. Good luck, everybody. And take care.
Thank you, Gary. Marvelous. Thank you very much indeed. Looking at this chart here, we're looking at weakness appearing in the market again. No demand. You've got a bit of strength here, but if it comes down, it should test the bottom. 1406 will be the target just down here. Okay. Well, you've seen this trade live. In fact, it's moving down now. So we do trade what we see, and 1400 I think is a fairly realistic target as well. So I hope you've enjoyed today, everyone, and thank you to Stevens Hahn. Thank you to Dr. Gary Dayton. I'm extremely grateful for both of you coming in and contributing to the course, and I hope all of you in this room have actually enjoyed today, and I apologize that we've overrun. We're an hour and 20 minutes over our allotted time for this course, but the most important thing is that you've learned something. And if you've learned anything today, the one thing I've certainly seen is when Tom Williams says go short, he saw supply hitting that market, which it did, and the supply has not disappeared. So from all of us at Trade Guider, from Dr. Gary, who is a partner of Trade Guider, and from Stevens Hahn, at Infinity Brokerage Firm. We thank you very much for today. We hope you've enjoyed it, and we'll see you tomorrow, same time, same place. It's all about live trading tomorrow, everyone. We've made money this week. We're going to make some more. Take care. God bless. Bye-bye.